All right. The floor is all yours, Debashish.
Hello. Good evening, guys. Good evening, good morning, wherever you are. So welcome to this, and I hope I will torture you enough over the next 2 hours, so that you may probably want to get out of this very quickly. But anyway, getting into this whole thing, what we'll try to do, the topics we'll just try to cover over here. I mean, broadly, of course, financial markets as a whole. I hope it's kind of relevant to a lot of people, just because, all of us are obviously doing investments in some form or the other. So what I really like to do first is, take you through the background of what's going on across markets around the world, just to give, a little bit of context setting for a lot of things, introduce a few concepts here and there, as and when we go along. Then we'll kind of go to the next stage where we try to interlink the concepts together. Because nothing is simple, straightforward. Nothing works in a straight line. There's a lot of kind of effect, cause, effect, back and forth, which keeps going on. From there, we'll kind of come to the current situation. Where things stand, how the markets look like, what is the current setup, and then kind of use that to project the path forward. Now, in this part, I've kind of, made it in a way that we can all sort of, try and look into this together, because enough of concepts would have been introduced, hopefully you would have retained a few of whatever I say through that time. And then we'll try and use that to, kind of evaluate how things are going forward. And then, of course, I'll just wrap everything up in some time. What I just request maybe is to hold on a bit on the questions. Simply because, a lot of times queries you have in one slide may well get answered in subsequent slides, because, there's just so much which sort of comes back and forth and intermingles and all that. Having said that, I mean, should you have queries, I mean, obviously keep them with you. And then once we get into that looking ahead part and all, because it gets a lot more interactive, we can kind of make it that way as well at the time. Okay, so that's where it is.
Yeah,
so
you can also put the questions in the chat as they come along, and later on, Debashish can cover them.
Yeah, so that I will do. And in between, just to warn you, my dog may go in and out. So please bear with me if, you happen to see that. So anyway, just getting started. What we'll do is first just look across the various asset classes. I'll go into details of each as we go along. So just to define the broad and, just to set context, I'm really focusing on financial asset classes over here. I mean, of course, there are multiple other asset classes also, whether, the biggest of which is real estate. And then, depending on what somebody's interests are, it could go from art to wine collections to whiskey collections and so on and so forth. So there's no end to it. But we'll just focus on, the broad, well-known asset classes over here: stocks, bonds, commodities, and currencies. Lots of data available on all of these. They're all traded on financial exchanges around the world. So obviously a lot easier to analyze these markets as well, at least in terms of availability of data. The analysis, may be up for question. So let's start with the equity markets. And what I'll just try and do in this part is kind of just introduce major markets, some of which, of course, you may already know. And then just try and see how these markets have performed over the last 2 decades, really, as a bit of a, background to where we are today, just looking at the 2 decades back. In some cases, I may touch upon a little bit of history further back from there as well. So when we look at broader markets, especially from the point of view of the investment world, we've got the developed markets and the emerging markets. And that's how broadly, the universe is set up. In terms of actual money put to work, which is investment capital put to work.
Debashish, we can't see the screen properly. Sorry to disturb.
Not proper? Even now?
Well, I think maybe your Wi-Fi link weak.
Okay. No, should not be.
Let's go.
Did you pay your bills, man?
Switch off video, boss.
Let me do that. Broadly, world is divided into developed markets and emerging markets. These are the divisions of the developed markets themselves. I mean, fairly self-explanatory, actually. And the US is the biggest part of it. There's Europe and the other sort of APAC countries which are considered developed. And then a whole swath of countries come under emerging markets, whether it's Asia, EMEA, Latin America, and all. Okay, and then just to look at how they've performed over the last 2 decades, it's almost been like a tale of two parts. So from the beginning of 2000 till about the financial crisis in 2008, 2009, by far the emerging markets were the best performers. And on the other hand, something like the NASDAQ was the worst performer. Whereas post the crisis, all of this has absolutely flipped over. And the NASDAQ actually has been the best performer. Emerging markets have been the worst. And even within, when we look at the US markets as a whole, which have done well, so whatever the S&P might have delivered over that period, about 7-8% on an annualized basis, it's what it's delivered. The NASDAQ has done about twice of that. And then if we just look at the FANG stocks, they've done about twice of what the NASDAQ has done. So there's been almost like a massive concentration of performance coming from the technology space as a whole, the FANG stocks in particular, which have really contributed to market movements around the world. On the other hand, emerging markets and all have been almost flat, especially when you look at them in dollar terms, because a lot of them, their currencies have depreciated against the dollar. That's an aspect we'll come into a little later, but just to introduce it over here. From here, let's go to the bond markets, kind of a little more complex, obviously, compared. Yeah.
Do you know the reasons?
Sorry, can't hear it.
Do you know the reasons? Can you think of any reasons why these perform really well?
Sure. Some of your voice is not coming clear. Anyway, the reasons for it are actually fairly simple. A lot of it really has to do with, where money has been flowing, where, the sort of risk versus reward versus, whatever is going on fundamentally as well. All of these, impact what's going on. We'll kind of touch upon a lot of these things down the road where we look at reasons for why some things happen. But if I were to just put it very, very simply, the NASDAQ had actually done very well going into 2000. So almost it had gone into, an excess territory on the other hand. Emerging markets, on the other hand, had got particularly battered in that period, especially 97, 98, 99. So from there, when the transition happened, and then you had the growth of China coming into the WTO, and then the other emerging markets also doing pretty well. So a lot of money really flowed out of the US and towards, emerging markets, which, caused them to do pretty well. And then once we went to the crisis and, the excesses in emerging markets developed, then we went into the crisis, which kind of happened all over. The trigger for the crisis may have been something else altogether, but it affected things all over the world. And then you had all this extraordinary monetary policy action happening in developed markets, to start with the US, later Europe and all, which were very supportive towards their financial markets. Again, I'll go into how that whole thing works in a little later part. But that's really kind of the reasons for why we saw this divergence of performance. And that's very typical. You'll have certain periods where a particular part will do pretty well. And then there are periods where something else will do pretty well. And it's possible that the next 10 years, again, this thing may well flip around.
Thank you.
From here, we'll look at bond markets, which, again, there are multiple ways in which bonds are categorized. Which, if you look at all these things put together and you take one out of each of these blocks, it'll give a complete picture for a bond. So a bond could be of, issued by different types of entities. It could be the governments which are issuing bonds. It could be companies issuing bonds. It could be local bodies like municipal corporations and all issuing bonds. Or it could be bonds which are backed by some assets. The most common one being like the mortgage loan which we have. So that's in terms of who is issuing the bonds. They could, of course, be issued by any, an entity in any particular geography, or even including governments, which is similar to what you saw on the equity market side. Then depending on, again, who the issuer is and, what are the prospects for the issuer and all, each of these bonds gets a different rating by these rating agencies like S&P and Moody's and all. which is just a reflection of how good their repayment capability is. So you could have something called a sovereign rating, which really stands for bonds issued by government entities. And then you could have a more high quality bond issued by a private entity like a corporate or something, which is known as an investment grade bond. Or you could have something of a lower quality because the company's own fundamentals may not be all that strong. And that's referred to as a speculative grade bond, or another word for it could be a junk bond. Okay. And then you have bonds which are issued for different periods. So it could be a 1-year bond, a 5-year bond, a 10-year bond and all, which again, then have different characteristics depending on how we kind of look at these. Now, how a bond works, and feel free to interrupt me on this slide, if there are any queries which come up, is that, let's just take a typical bond. Let's say it was issued for 100 rupees and it pays a coupon of 10%. I mean, I wish there were too many bonds paying all that today. There's hardly much, but in any case, let's assume it was paying 10%, and let's say it is a 5-year bond. So typically what you would get in a bond like this is you would pay 100 rupees on day 1. And then at the end of year 1, you would get back 10 rupees. Similarly, year 2, year 3, year 4, year 5. And at the end of year 5, you'll also get back the principal, which is the 100 rupees you had invested, plus the 10 rupees of interest. So that's how the payoff would look like. Now, if you were to transact in this bond somewhere before the bond matures 5 years down the road, so let's say in year 1 or year 2 or year 3, at some point you transact. Now, what is the price you would sell that bond, and what is the price somebody would buy it from you? Now, when this bond was issued, the interest which it pays, which is 10%, would be somewhere in sync with whatever are the interest rates in that economy. So let's assume it's a government bond and the interest rates by the government are somewhere around that level. So then that's what the coupon rate of 10% would be. However, let's say 2 years down the road, let's assume the interest rates fall down to 8%. Okay. So at this point, as a seller of the bond, it would make no sense for you to give something, give off a bond to somebody else, which is paying it a 10% rate of interest, because in the market, he can't get that. The best he can get is maybe 8% in the bond. So what you would then do is sell the bond at a price which is somewhat higher than 100 rupees, such that the yield on the bond to the person who's buying it works out to 100 rupees, works out to 8%, sorry. So therefore, if the interest rate in the economy goes down, which is therefore you will, a typical bond would then, if it were to be issued fresh, it would only be paying 8%. So therefore your 10% coupon bond would be highly desirable for people. And therefore you are in a position where a lot of people would want that bond from you. And hence you would tend to sell it at a higher price than the 100 rupee price. So therefore, if the interest rate is down, or which causes the bond yield to be coming down, instead, because of that, you'll have the bond price moving up. On the other hand, assuming interest rates at that time were 12%, then the demand for your 10% bond is less, because you can just invest in the market and get 12%. So therefore, you will have to then sell your bond at a discount to 100 rupees, so that the effective yield comes to 12%. So therefore, your bond price will at that time come down, because the interest rates in the economy and therefore the yield which is coming from a bond would have gone up. Is this part clear to everyone? I'll take that as a yes. So
yeah, makes sense.
Yeah.
Okay. Okay. So from this, let's now just look at a few concepts within this. So when we're saying that a bond yields 5, 7, 8, 10%, whatever the rate is, what we're really referring to is something called a nominal bond yield, which is just like call it like a printed label on a bond. That's what it's returning. But that's not actually what is the returns you're making, because there's a certain amount of cost which you have to bear, which is known as inflation. which is just the price increase year on year. So what inflation does is kind of take away from your return. So let's say if it was a 6% bond, but if your inflation is about 5%, so by putting money at 6%, it's not that you're actually making 6%. 5% out of that is actually going away because of inflation. So you're effectively only making 1%. So the difference between the yield of a bond and the rate of inflation is something called the real yield, which is, the equation is right there below, over there. Now, real yield is a very important concept because it almost determines what are the kind of investment decisions you will take at any point in time. Again, I'll go into this in a little more detail down the road, but just keep this in mind. So this is a bit of a history of bond yields. And just for simplicity, I have taken the 10-year bond rate for the US. Now, why did I do that? Because why 10-year and why US? So 10-year usually is representative of longer term trends in any economy. It's also kind of representative of some of the long-term borrowing which somebody may be doing, whether a government is doing it, whether a corporate is doing it, whether you as, borrowing for your house are doing it. So it's a good reflection of longer term economic fundamentals. And why the US is that the US is the US owns the reserve currency, and there is a close linkage between bonds and currencies. So for instance, let's say the interest rate today in the US is 1%. And let's say the interest rate in India is 5%. Okay. So you would think normally that it's a no-brainer to just put money in India and get 5%. But the fact is that you don't actually make that much because the inflation rate in India is higher. So the extra money you're making, a good part of that is actually going away because inflation in India is higher than inflation in the US. And this difference in inflation between two countries is reflected in the currency markets. So if I were to convert dollar to rupee today versus if I were to convert dollar to rupee 1 year down the line, there'd be about a 4% difference, which is I would have to pay a 4% premium to get the same sort of dollars down the road compared to what I'm getting it today. So that differential sort of takes away whatever the difference in the interest rates is. So which is why your bond markets and currency markets tend to be fairly closely linked together. Now, because the US owns the reserve currency, which is the most important currency in the world, therefore, what happens in the US bond markets in some way, shape or form also reflects in other bond markets around the world. So that's the reason I've kind of taken US 10-year bond yield as a representation over here of certain longer term trends in the bond markets. So if you see over here, and this is actually a history right from the 70s down to today, there is a reason I've taken 1971 as a start in terms of the history sort of timeline I've put over there, because that was the year where the US dollar became a free floating reserve currency. Prior to that, the dollar was linked to gold. So in a way that the US could only have as much money depending on what was backed by gold. But in 1971, they sort of delinked that and the US dollar started floating freely. So it was kind of a seminal point in currency history. So since then, we've had different events which happened. The immediate effect was, there was some sort of chaos in the markets in terms of the prices for oil, because a lot of that is denominated in dollars today, but that had not happened at the time. So these kind of things happened. So because of which a lot of inflation happened, and inflation actually went into double digits, almost getting close to, high teens. So which then meant that, and they were, just finding it very, very hard to control it. So there was a central banker at the time for, the Fed chairman at the time. His name was Paul Volcker. So he came in and he sort of, in the early 80s, tried to put a lid on inflation. Look at inflation is like this pesky kind of thing, which, it's not so much the actual inflation itself, but it's what the market perceives inflation will be. which sets everything. So if it perceives that inflation is going to be higher, then everybody will then go and start pricing their goods higher for the next year and so on. And therefore inflation automatically will become higher. So it's about how you control the expectations of inflation. So what he therefore did was that really jacked up the interest rates to put a lid on inflation. Now, how does that happen? When you take up interest rates, basically the cost of borrowing for any business which you're doing goes up, or even any functioning of the economy, the cost of borrowing goes up. And when the cost of borrowing goes up, then obviously your ability for growth will come down because your costs are going up. You don't know whether you'll be able to pass on those costs to the customers or not. And in that event, chances are business will get curtailed. When business gets curtailed, then the expectations of future growth come down. When the expectations of future growth come down, then the possibility of having prices increase too much in the future, that comes down. And if prices are not going to increase too much, then inflation expectations come down. So that's the whole cycle. So therefore, using that, he really took up interest rates tremendously. As you're seeing, it's gone all the way till 16%. And as a result, put a lid on inflation. And since then, it's been a brilliant ride on the way down in terms of interest rates. They've just been coming down. I mean, of course, there's been a little bit of volatility in the way, but the broad trend has been clearly down. If we go back to our previous slide of bond yield versus interest rate. So if bond yields are going down, bond prices are going up, which means a portfolio of bonds would have done extremely well over this last 40-year period. So this is just to summarize how bonds have done. Now, by and large, all types of bonds have done well. I mean, unlike equities where, certain things did well and certain things weren't really doing well, in terms of bonds, they've tended to do a whole lot better across the board. But within that, pre-crisis government bonds were tending to do a little better compared to corporate bonds. Whereas post-crisis, it's been the corporate bonds which have done a little better. The reason again for that is that post-crisis, the central banks have taken, dramatically reduced interest rates, due to which, the actual amount of interest you were getting was very, very low. Now, a lot of investors in the bond market are obviously putting money there to actually get an actual return and not just a 1% interest or a 0.5% interest, because the kind of big investors in bond markets are like these pension funds or endowments or, sovereign wealth funds and all, who all have an actual liability in front of them in terms of what they need to deliver. And if that's not happening, then it really doesn't make a whole lot of sense for them. So therefore, they, instead of buying government bonds, started buying more corporate bonds. Now, corporate bonds tend to have a higher rate of interest compared to an equivalent government bond, like a 5-year corporate bond should pay a higher rate of interest compared to a 5-year government bond, simply because the government has the power to tax. So therefore, the ability to get money back is a lot more stronger with the government. And therefore, it's considered as a safer investment, and hence it can charge a lower, it can get away with, paying a lower rate of interest. Whereas a company will, does not have as many ways to ensure that it gets paid its interest, and hence has to pay a higher premium in the markets in terms of the interest it pays. And again, depending on the quality of the corporate, if it's a strong one, it can raise money at lower rates. If it's not such a great situation for the company, then it obviously has to pay up to borrow money in the bond markets. So net result of all this has been that a lot of money has gone into bonds, which can potentially give higher yields, like these more junk bonds type of things which I was mentioning. And the situation, what it has created as a result, is that there's a huge amount of bonds which are now in issuance around the world, which are coming from fairly low quality companies, but they've all found takers simply because people are desperate to get some sort of yield on their bond investments. So just park that thought again with you, and I'll come back to it at a little later date. Now let's move over to the commodity markets. Broadly, four types over here. We've got precious metals on one side, which tend to, really have more investment applications as opposed to industrial applications, and that's how the segregation really happens. Whereas industrial metals, obviously have strong industrial applications. Energy markets, because of their sheer size, especially of oil and gas and all, tend to be taken as a different category altogether. Within that, oil, obviously had massive importance, especially over, I mean, it still does, but it was the pretty much the heart of, what happened over the last century or so in terms of mechanization, motorization, etc., because all of that was based on oil being there. So when, if I go back to this timeline, which I was talking about, and the oil shock and all, this was the time when the whole petrodollar system came into existence. What petrodollar really refers to is that now oil is needed by everybody, but what do you pay for, how do you pay for oil? What is the currency you would use to pay for oil? Would you pay it in dollars or rupees or yuan or gold or whatever the case may be? So what really happened, post all this 1974 is that the US reached an arrangement with the big oil producers, which is the OPEC countries, wherein they would pay for, oil would be priced in dollars worldwide. And that ensured that the dollar actually had an anchor in some way, which was kind of based on oil. And everybody would always need dollars because you always need oil. So that's really the heart of what happened. Okay, so coming back to this. So we've got all these markets. And then the last one is the agricultural commodity side. Which is, again, obviously, so agricultural commodities are also known as soft commodities, whereas these industrial metals are also known as hard commodities. That's another way to just call them that. They're also the reason why derivatives markets exist today. I'll come back to this point in a little more detail down the road, but just as a little background over here, I mean, I'll explain a little later why I'm talking about derivatives, but just as a background over here, that, we've had trading of commodities since centuries. Typically, when you had to ship goods from one place to the other, it used to take about 3 months or 6 months or something to ship goods from, let's say, Europe to India might have taken 3 months, somewhere else to somewhere else may have taken 6 months, just depending on the time and distance, obviously. So if you were to book a shipment today, which is going to come 3 months down the road, let's say a shipment of cotton, there's no way of knowing how the cotton price would be 3 months down the road. Now, what is the price which you agree upon when you're entering into this transaction, so that somebody doesn't renege on the transaction 3 months down the road, depending on how the price has moved up. So because of this, a whole new market came into play called the derivatives market, where, let's say, 3 months down the road, people would enter into a contract, which was known as a forward contract. So a 3-month forward contract, let's say on oil, on cotton, because cotton was just like a hugely important commodity at the time. So which would then decide today what the price of cotton would be 3 months down the road. Now that price of cotton would be in some way linked to what is the price today, of course. And then you would add, let's say, a 3-month interest cost on top of it, because the actual person would only get paid when the shipment would be delivered. But from his side, the seller is out for 3 months, where he's waiting for his money to come in, whereas he's already obviously got rid of his inventory. So that 3 months of carrying cost of the inventory was reflected in the extra price of the forward contract of cotton, which would happen. So that was kind of the origin of where derivatives came. I'll come into this part a little later and where this importance kind of comes in. But anyway, coming back to the commodity side, how have the performances been over different periods? So oil, and I didn't mention industrial commodities over here because oil was the best. But in the sort of financial crisis period, oil and industrial metals did very well. And a large part of that was to do with the fact that China was growing very, very strongly. Rest of emerging markets also were growing pretty strongly in terms of, actually putting up capacities, consuming more oil, all of those things were happening. And then simultaneously, for all these commodities, like I mentioned, the derivatives markets and all. So there is the actual real world use, which is, the oil we are consuming or the copper we are consuming and so on. And then there is financial speculation, which happens in it in the derivative markets, which you can almost classify these as two different things. One is real use and the second is financial use. And financial use also is obviously very strong in periods where real use is strong. Because if you're anticipating, China is going to consume a lot of commodities, you will go and buy those commodities yourself, invest into that. So which will, and if the size of the derivative markets is big enough, it will push up the price of those commodities. So what was also happening at the time is that a lot of hedge funds were basing themselves out of China in terms of taking shipments of their commodities into China, just showing it as shipments coming into China. So not all of the consumption was necessarily just China consuming. I mean, they were literally consuming half the world's commodities, but not all of it was because of their own demand. A lot of it was also financial demand, which is kind of happening. Now, post the crisis, when all of this sort of thing changed and the sort of center of gravity of the financial world shifted from emerging markets back towards developed markets, where obviously a lot of policy action was going on from their central banks. And on the other hand, emerging markets broadly slowed down. So then a lot of the speculative activity also stopped. So since then, oil, industrial metals and all have really been a bit of a no-show. They clearly made their high around the 2007-2008 period. Gold, on the other hand, has been relatively good in both periods. It did pretty well during the first decade and then kind of hit a peak in 2012 and then went into like a 6-year hibernation where it actually fell all the way from about $2,000 per ounce to $1,100, $1,200 odd dollars per ounce. And then now it's come all the way back. So net over a 20-year period, it's probably been the best performing commodity out there. And agriculture, on the other hand, has been hands down the worst performing commodity. Combination of reasons, I think just, we've had fairly good periods of weather. So production has been fairly high. It's been, periods of growth in general and not had too many shortages at any point. So therefore, and money has also not necessarily therefore flowed in and it's gone to other places. So agricultural commodities have been pretty bad, and that's been the case not just over the last 20 years, it's actually been the case over the last 40 years. Again, just keep this thought in mind. I'll come to it at a later stage again. So now from this, we'll just move over to the last big asset class, which is currency markets. Now, currency markets are a little different in that while in the other markets, you're trying to, obviously see the absolute performance of one particular commodity or stock or market or whatever it might be. In currencies, it's always one versus the other, which means I'm always, if somebody asks me, how did the rupee do? The question is, what are you measuring against? Is it against the dollar? Is it against pound, against euro, against yuan, whatever, So that's important, just to lay out what is it that you're measuring it against. And consequently, it has its own, kind of movements. Now, what we will look to measure it against, just as a point of comparison, is against the reserve currency, which is the US dollar, which is how have the various currencies performed against that. And this little definition of currencies, which I've just given on the side, this sort of just describes, kind of the utility of currencies. So it could be either somewhere, what it means by when I say that a currency could be a store of value, it just means that, you're using it to measure, let's say like, or just keep money. I mean, basically it means, if you're keeping money in the bank, effectively, it's where you're keeping a part of your net worth. Somewhere. So it's like sort of a place to park your net worth or your value somewhere. Alternatively, of course, if you're transacting, then you have to use currencies. So that's where it becomes a medium of exchange. Or when we refer to it as a unit of account, where I'm saying, okay, a stock is worth $10. So therefore, that's where it's acting as a unit of account. A stock could be worth $10. It could be worth 5 ounces of gold. It could be worth something else, you know. So that's where currency being used as a unit of account comes into play. Again, I'm touching upon this because currencies are going to be hugely important in the decade ahead. And there will be, you know, periods where, you know, we have different ways in which we define currencies and how we sort of use them, and which will kind of define how the investment environment shapes up. Okay. So let's just look at how markets performed, and this will kind of also give an answer to the first question which you had, which is particular reason why equity markets, you know, why emerging markets might have done well pre-crisis and US markets post-crisis. This is also a big factor in that, which is the currency markets. So pre-crisis, emerging market currencies did pretty well, whereas the dollar was the weakest. And a lot of it really had to do with the fact that money flowed out from dollars into other currencies. Because remember, it's always one against the other. So people would have been borrowing money in dollars and deploying it in other currencies, and therefore looking to capture that difference. Because let's say if the dollar is depreciating and an emerging market currency is appreciating, it's almost a no-brainer that you should just borrow it in dollar terms, deploy it in that emerging market. The currency goes up, the borrowing currency goes down. You hopefully make some returns on whatever you deployed it in. You know, let's say you deployed it in India and bought some stocks with it. The stocks have their own appreciation, hopefully. And then when you, let's say, bring it back into the US a year down the road, you would have, you know, gained on all these fronts. Now, of course, this can flip the other way as well. And that's kind of what happened post-crisis, where a lot more money flowed back into the US, and therefore the dollar did very well. And on the other hand, emerging markets were the weakest performing currency. So there tends to be a close correlation between currency and stock market performance. So that's really the background to it. Any questions at this stage?
Hey, Bose, this is Monty. I had a question. So you said in 1971, there was a delinking from the US dollar to the gold.
Correct.
And why was that? Why did that happen? And how was that allowed to happen?
Well, I mean, it kind of happened because the US wanted it to happen. That's probably the short answer to it. And the US had the wherewithal to get it done. So that's happened in the past also. It's not that, you know, things have always been linked to the dollar, to a gold or, you know, some sort of real currency like that. They've been, you know, prior to this, the pound used to be the reserve currency, you know, when the heyday of the British Empire was there. And prior to that, you know, you've had periods where the Portuguese or the Dutch and all of that have had reserve currencies. Back in the day, the Roman currency was the reserve currency. You know, that's really the short answer to it. The official sort of angle which they gave to it was essentially a lot of people were basically stockpiling gold and, you know, kind of using that to exchange against dollars and creating, you know, issues in the currency markets and all of that. I mean, that's kind of the official reason they kind of gave to it, which is why, you know, that's sort of, that's how they kind of delinked it. Earlier, it used to be completely pegged to it, you know, prior to, I think, around 1917, 1918 or somewhere at that stage, used to be, oh, I might have got the years a little wrong, but it used to be pegged to the to gold. After that, it wasn't necessarily pegged to gold, but the amount of money you could issue was linked to the gold reserves they had. So it's not like the value of the dollar would necessarily move up and down with gold, but the amount of dollars you could have was linked to that. So then what they did in 1971 was delink that as well. So the last sort of, you know, connect. So it effectively allowed them to print a lot more money without repercussions, so to speak.
Got it. Thanks. And what about in India? We are still pegged, right, to the reserves?
No, we are not pegged to the dollar. We are at least officially a freely floating currency. However, it's very difficult in today's world to have your currency go very differently from other competing currencies. Competing currencies here means, let's say, currencies with whom you are, those countries with whom you are competing for, let's say, exports or things like that. So, if the other Asian competitors are weakening their currency, it's not really possible for us to be strengthening our currency. So there seems to be, a little bit of a link between that, but officially, at least, we are not pegged.
Cool. Thanks.
Hey, Bose.
And anyways, some of these, go ahead.
Bose, Pradeep here. Just to extend the question to, I'm hearing a lot of noise, sorry. So are there any currencies in the world where the reserves are pegged to gold?
No, they're not.
And do you think this is eventually going to give us a disaster later on because everybody is free to print as much as they want?
Well, that part, you'll only figure it out as we get into that looking ahead section. So I'll touch upon all these concepts, once we get there. So I guess let's move ahead because I think the questions you're asking, a lot of them will get answered as we go into this. Okay.
Thank you.
Yeah, sure. So firstly, let's start with, just sort of playing around with a few of these concepts. To start with, let's just take the most obvious one, which is, we always talk about, okay, a particular economy is doing well, stock market should also do well, and so on and so forth, sorry. Yeah, so the economy is doing well, growing strongly, so the stock market should do well, and so on and so forth. Okay. But that's not always the case. What we typically have, Anand, do you have a question?
No, I'm sorry, I don't.
Oh, okay. But if you just take a look at how the economies, the breakup of GDP is there on one side, and then you look at the breakup of something called the MSCI World Index, which, for those of you who may not know, MSCI is an organization which creates these indices which are used by the investment community worldwide. MSCI stands for Morgan Stanley Capital Index, actually, but these are, indices on which also a lot of money is invested worldwide. Like a lot of the ETFs track these indices. A lot of other mutual funds also will broadly be cognizant of these indices when they're doing their investments. And it's a reflection of where, money is allocated worldwide. So if you see, the US is less than a quarter of world GDP today, whereas its share of global equity markets, for instance, is about 2/3. So, clearly there's a bit of a divergence. Similarly, you look at something else on the other side where, let's say, China is 15.5% of world GDP, but it's not actually figuring in this, but it's actually part of emerging markets. Now, emerging markets is roughly about 12-13% of this MSCI World Index, and China would be roughly about 40-45% of emerging markets. So that would roughly put it at about, say, 5% weightage, or even less than that. So versus 15% of world GDP, it's barely even 5% of world stock markets. So India also, let's say 3.3% of world GDP, it's about 1.5% of world equity markets. So, so there's a divergence, no doubt. Now, there are a few issues here. Firstly, of course, how the investment landscape was set up. Simply because emerging markets have evolved several years after, or even decades after, developed markets, which has meant the investment business in developed markets got set up several decades before. And also their per capita GDP is obviously a whole lot higher, which meant the sizes of investment managers, like the amount of assets they manage, is a lot bigger because, obviously people have much more disposable income, which is accumulated over the years, and then the markets have grown. So, that's grown to a bigger amount. And that's created, this kind of, divergence, shall we say. The second aspect is also that in today's day and age, GDP isn't necessarily reflective very much of how value is captured. And let me give an example with that, because a lot of you will actually be familiar in your own industries with what I'm really talking about here. But let me just give a very simple example. Let's just take Apple, for instance. And correct me if I'm wrong in some places here and there on the technicalities, but just bear with the story. Which is that, let's assume, a lot of the thinking behind the design of, say, an iPhone or something would probably be done in Palo Alto, for instance. Now that design or whatever is coming out of that design, that's probably just getting emailed to the vendor, say Honhai or somebody in Taiwan. So the intellectual property is actually there in the design itself, but that's getting emailed out for free from the US to Taiwan, let's say. And then from Taiwan, Honhai, it's probably sending it to either its factories in Taiwan or in Hong Kong or somewhere, and it's producing that that phone over there. Assuming the phone was worth about $100 finally. So the margin which Honhai makes on producing that phone is probably just about $5. There is a reason why all of this was outsourced there, because just the sheer low margins at which they're able to produce is helpful. And then of course you've got different components which come in. By margin I meant their own labor and whatever other margin they're charging on it. There could be other costs also obviously which come in. The biggest cost would of course be the processors and all that. So let's assume all of those costs put together is say about $30 or so. So net for about $30-$35 an iPhone is ready. Now there'll be some offshore entity of Apple, let's assume Apple Ireland or somewhere like that, which is basically based in some low tax jurisdiction, that would then be buying this shipment of iPhones from whichever factory is producing it, let's say in China. Okay. So it's buying that at $35, let's say. And then that same shipment is actually getting, there's whichever jurisdiction they're buying it probably is just a tax haven. So the actual shipment is, let's say, then going into different countries. Let's assume US, India, wherever it might be going. Let's assume it's going into the US. So the landed cost into the US is taken at about, say, $90 or so. Okay. Or let's say $90, $95 or something like that. So effectively what has just happened in terms of transactions is that the Irish entity, for instance, bought it for $35 and that sold it to the US entity for about $90, $95 or so. So that $60 odd of margin was captured, which is really Apple's profit, was captured by this entity in Ireland or wherever, or whichever tax haven. Now at about $90, $95, the shipment came into the US. And let's say you tag on about a 5%, distribution margin and a 4-5%, retailer margin, and say the final product is sold to the consumer at about $10, about $100. Okay. So what just happened in GDP terms is that it would just show as a $90 import into the US and a value add of say less than $5-7, because most of it is anyway just a retailer margin or something. They're not actually adding any productive value on it. So let's assume there's a little bit of value add coming there, negligible almost. So the actual GDP captured within the US is next to nothing, and there is a trade deficit on top of it. Okay. But in terms of profits, it's a completely different picture. Okay, because actually $60 of profits has got captured by Apple. It's just a different entity. Now that profit which was captured in that tax haven is then reinvested back into the US via Apple's treasury operations. And how they would do that is maybe they'll use a part of it to buy back their own share, which is something which they have been doing over the last few years. Or they would park the money in, let's say, government bonds in the US, or they could even be making other investments with it. Now, the stock market really values this profit, which is the big $60 margin, which is getting generated by by Apple. Okay, and that's why it gets the kind of valuation which it is getting. On the other hand, the GDP measurements are only capturing this import and very minimal value add, which is coming into the US, for instance. And that really is what creates this divergence between what you see in GDP and what you see in equity markets. And this is a story in different, across products. I mean, literally, because just the way once we get into this whole globalized value chain, supply chain, it kind of changes things around. The corollary to all this is that if you bring supply chains back into the US, hypothetically, let's say for Apple, if you were to bring supply chains back into the US, all of this capturing of profits in a low tax jurisdiction will go away. And that will have implications on the valuation of whether it's Apple or any other stock and so on, because the costs will of course go up, because it may be impossible for them to turn around that at $5 within the US, given labor costs are a lot higher. And the taxes will also obviously go up compared to whatever it is they're getting away with in different markets. It will of course show as better GDP, because more of the value addition on those components to produce the final phone will all happen in the US. So the GDP will look better, but the profits will look worse. So you could see GDP growth, which is stronger than what is the GDP growth today, but you could see profit growth, which is, or even profit declines potentially, which cause the stock markets to behave again very differently. So this is something to just keep in mind. Let's now also try and link between stocks and bonds. So if you recall that bond yield thing which I was just describing back in the day, there's a way to compare that with stocks via something called the earnings yield. I mean, earnings yield is effectively nothing but what yield a company is giving you, because of the profits it's generating. So which is the profit divided by, say, the price of the stock is effectively the earnings yield. So if I flip that around, on the other hand, earnings yield divided by profit, if I just take the inverse of that, earnings yield divided by stock price, if I just take the inverse of that, you basically get the PE ratio, which is one of the most commonly used terms to try and, measure across companies or across industries to see, whether something is relatively cheaper or more expensive. So theoretically, bonds are supposed to be riskier than, bonds are supposed to be safer than stocks. So therefore, you should get a lower yield on a bond compared to what you get on a stock. The reason also why bonds are supposed to be less risky than stocks is that assuming a company goes into liquidation, then it's become bankrupt, it's gone into liquidation, then you have to first pay the bondholders, and then from what money is left, the shareholders can get something, if at all. So that's why bonds come higher in priority, and hence they're supposed to be less risky. So then we can take the implication of that into an equation over here, which is that whatever the bond yield is, the earnings yield should be a little above that. So if you take the inverse of it, then the P ratio should be a little lower than wherever the inverse of the bond yield is. So if the bond yield is 5%, if I invert it, that's about 20. So the P ratio hypothetically should be lower than 20. And if it goes above 20, at least hypothetically, it's an overvalued market. It can stay overvalued, and that's a different matter altogether. But at least from a theoretical construct, this is something which is useful to keep in mind. And this kind of always gives a link between stock markets and bond markets. Now let's come back to that whole yield discussion we were having, and this thing called real yield, which I referred to over there, and how it sort of drives investment behavior. So real yield, as I had described, was essentially the actual yield you're making, which is whatever is the printed yield, and you take out inflation from that, and you get the real yield. So which means that when real yield is negative on a bond, it's basically saying that there's no merit in actually investing in the bond. So you could be investing somewhere else, because what do you have to lose anyway? You're not really making money. And that's when you start looking at other investment options. When is the time when you get real yields which are negative? If you just look at this equation, when inflation is higher than the nominal yield, real yields will be negative, which means whenever inflation is running stronger than whatever is the printed yield on a bond, is when real yields will be negative. And that's why you typically have this connotation also of, when inflation is happening, maybe look at some stocks, maybe look at gold and all that. The basic reason is this, that your real yield is negative. It costs you nothing not to own a bond. So you could maybe own gold or something, which gold by itself doesn't pay any interest, but interest rates are anyway negative effectively. So I may as well put gold. Or let's say I can look at some stock which is probably giving a higher, maybe a dividend yield which is higher than this or something like that, or its earnings yield is higher. I could look at a stock to do that. So when yields tend to negative territory, investors are forced to look at less risky options. And that's where, investors are forced to look at more risky options, and that influences investment behavior. Let's touch back here upon the currencies side. And there was some questions, which you had asked about pegged currencies and all. So I kind of go into some of these concepts over here. Firstly, just to sort of define currencies. So when, something is linked to gold, as you were asking, is it pegged to gold or some other resource or something? It's usually referred to as real money. The word real money really just comes from the fact that it is pegged to some real asset, which you can touch and feel and so on. However, currencies for the most part today are not really, like that. They're not pegged to any resource really. And you can pretty much, move money around digitally. So fiat currency, by definition, what it really refers to is paper currency. But increasingly, it is not even staying as paper even. It's really becoming digitized. And when we take digitized currencies or digital currencies, I mean, that's, there's a bit of a talk also going on around digital currencies, and also, with Bitcoin and all that coming in, more of that talk has started. It takes us into maybe the next evolution of currencies, which may happen quite quickly, which is something called central bank digital currencies, CBDC for short. Central bank digital currency is a little different from the current currencies we have today, which are also digitized. I mean, you can obviously, move it around electronically, as you very well know. But the critical difference is that today, let's say you are, you basically, have your accounts at some bank. Okay, so let's say for us in India, most of us have accounts, let's say in HDFC Bank. So for every 100 rupees I'm putting into HDFC Bank, the way the banking system works is that I deposit 100 rupees in it. Against the 100 rupees, HDFC Bank can go ahead and borrow say 600-700 rupees more. And then it can take all this money, keep a little bit of reserve aside, and then lend the rest of the money to, whether to somebody who wants a loan or wherever it might be, and hope to make a little higher interest on it. So it's, let's say, borrowing money from us at, whatever the rates of FD or savings account are, say at 3, 4, 5% or whatever it is. And maybe it's lending money, let's say for somebody who wants to take a home loan, for instance, it's lending money at say 8 or 9%. So that 4, 5% differential is captured by HDFC Bank. And it's essentially creating that money out of the 100 rupees which you deposited with it. It's creating 600 rupees more of loans, because it's able to borrow against the 100 rupees, it's able to borrow 600 more, and then it's able to lend all that out and make that interest differential on a higher volume of money, and therefore contribute to its profits. Now, when we move to a central bank digital currency system, what happens there is that the bank account which you have is no longer with HDFC Bank. It becomes straight with the RBI, which means HDFC Bank becomes more like a Paytm effectively. It's just a pass-through vehicle. It's not the entity which will have the power to necessarily create those loans as much anymore because you may not be putting, I mean, you can probably choose to keep your money with them. But if you were given a choice of having your money with the central bank versus a normal bank, you would typically choose a central bank because the central bank is the safest of all the entities. With a commercial bank, let's say, depending on which country we are in, there are certain limits up to which your money in the bank is guaranteed. In India, it's about 5 lakh rupees. I think in the US is about, I don't know, is it 150, 200,000 right now? It used to be about 100,000 back in the day. I don't know what it is now, but $100,000 or $150,000. Yeah.
$200,000.
200 now, right? So which means if you're a millionaire or more, you need at least 5 banks to be secure in the very least. And in India, that problem may be even bigger because it's just about 5 lakhs, which is covered by the banks. So, so therefore, you'd almost always choose to put your money with a central bank if you can, because, in that case, the central bank is the one who is essentially holding the liability to you. And it'll also, it can borrow against that and create loans in the economy and all of that. So it kind of competes with the same people it is regulating. So there can only be one winner when the regulator themselves start competing. And that's what CBDCs are all about. Now, why this can become a very important thing and why the allure of CBDCs will be very high is that with the help of CBDCs, the kind of control which the government can extend and in fact even decide which parts of the economy should get funding or not goes up exponentially. Now, if we go through a period of quite a bit of strife, let's say because of, what I think, Pradeep, you were mentioning, right? I mean, all this money printing and all that, will it create a problem down the road? And let's say it does create a problem down the road and basically causes everything to fall off like a pack of cards. Then to recover from that, we'll need a lot of support from the government. That support obviously becomes easier for the government to disseminate if it is able to control loans. Because today, even if it reduces interest, the point is the bank may or may not lend the money. It may choose not to lend it because the bank itself is not feeling like, it's going to get its money paid back. And so the benefits of a central bank reducing interest rates may not necessarily be passed on to the end consumers and all that. That's the good side of it. I mean, there can of course be the politically motivated side on the other side. So that's really the broader discussion on the medium side. In terms of how currencies are managed, I was referring to something called floating currencies, like the rupee is floating. What it really just means is you let the fundamentals of the economy, the financial markets and all of that determine what the price of the currency is. Very few things are truly floating, to be perfectly honest, because the central banks usually always try to do a little bit of management here and there and, control the currencies a little bit here or there. But to the extent it's possible, it is floating. Theoretically, of course, the big developed market currencies are floating. Well, the dollar, the euro, the yen, all of these are floating currencies. Pegged currencies, on the other hand, are where you're officially pegging your currency to something else. For a long time, the yuan was pegged to the dollar. And then the big hue and cry started, I think, over the last 8-10 years that, they were artificially suppressing the rate of the yuan and therefore, gaining on exports and all that. Which then what they did was they just moved aside from pegging it to the dollar. They just pegged it to a basket of currencies. They don't really reveal exactly what it is that they're doing. But broadly, it still moves fairly in sync with the dollar. But then you've got something like the Hong Kong dollar, which is actually pegged to the dollar. That's officially pegged, which is, the official reason at least is that, Hong Kong being a global financial trading center, it makes sense to, have a freely convertible currency and which is also pegged to the dollar so that it makes it very easy to have financial transactions happening around the world without worrying about the rate at which you're going to be converting the currency. Another example of pegged currencies is the Middle East currencies, which is where the petrodollar system and all came from. The Middle East currencies, because they are all pegged to the dollar, because the US was the biggest consumer when the whole petrodollar system was put in place. Today, of course, the US is a net exporter of oil, but back in the day, it was the biggest consumer by far, and hence the most important customer for the Middle East countries. So in return for, essentially assured offtake from the US, which meant that, obviously the Middle East countries were a lot poorer at the time. So which meant, assured income from these guys is why they pegged the currency to it. The US, of course, had its own objectives to get that done, because that ensured that the rest of the world would always need dollars, simply because you always need oil, as simple as that. And the third part is something called a currency union, which is nothing but pegged, but in a more cohesive, coherent, official form, which is that you're actually, the classic example of that is the euro. Now, before the euro came into existence, I think in the early 90s, you had each of the European countries having their own currencies. The German currency was obviously the strongest, and the broader North European bloc was the strongest, because they were, they still are really the industrial powerhouse. They had grown quite a bit since World War II. Effectively, if you look at Germany or something like that, they had, it was down in the doldrums after the Second World War, but then it recovered, and West Germany in particular grew very well. And soon it would have, sort of almost captured as much growth as it could within Germany. And therefore it desperately needed bigger export markets. Of course, the products were good and they would be getting exported all over, but there was no guaranteed export market for it. If I go back to the concept of pegged, what I was saying, if you recall, was that let's say the OPEC pegged to the US dollar, the OPEC countries pegged their currencies to the US dollar, because the US was the biggest customer. So it's like a guaranteed thing. So often the peg is between the producer nation and the consumer nation, so that you take away the effect of currency fluctuations, and it's much easier for you to transact on an ongoing basis. So with the currency union in Europe, what effectively Germany ensured was that every other European country was also now using the euro. So they all had a stronger currency. So whether it was the Italians, the Spanish, the Portuguese, etc., they all had a stronger currency to work with. So which raised their purchasing power. Also, when you had this currency union, it kind of meant that all of it, the risk level for the entire block came down in some ways, and risk is really reflected in terms of the interest which you have to pay when you're raising a bond. So let's say the Italian government, whatever rate at which it would have been raising money prior to the euro, that rate came down once the euro came into existence, because to some extent Germany's credit quality was said to be implicitly backing the euro, and therefore the strength of the euro means there is more faith in any instrument which is denominated in the euro. So if the Italians are issuing bonds in euros, there is more faith in that instrument. So the Italians were able to borrow cheaper, the Spaniards were able to borrow cheaper, and so on, which meant they had a stronger currency, they could borrow cheaper, so they themselves had pretty good growth in the sort of the last 2-3 decades of the previous century. Their growth was pretty strong, so which meant they were then able to buy more German cars and German products and so on. So Germany just sort of overnight expanded its markets. France, of course, also benefited to some extent, because outside of Germany, again, France has a lot of companies, and obviously they get a bigger pool of access of markets as a result of that. So that's really the concept behind it. When we talk of bonds themselves, bonds can be issued in different currencies, but the broad distinction really is, let's say it's the RBI which is issued, or let's say an Indian company is issuing a bond. Now, if the bond is issued in dollar terms, it's called a hard currency bond. That's usually preferred by global investors, simply because then you take out the effect of currency from the whole thing. Whereas if a bond is issued in rupee terms, it's known as a local currency bond, which is less desirable, obviously, because it's in another currency, so you have to worry about what the effects of that currency will be. And, what if the country just goes ahead and devalues its currency, then the bond sort of loses value. Devaluation of the currency really brings us to, again, Pradeep's question, which is what really happens if, all this unabashed, uncontrolled money printing goes on. And that's really what is bringing us into all this alternative currency space. Bitcoin, the whole premise of Bitcoin really is that you can't just print money as much as you want. There is only a controlled amount of supply available. Having said that, there are obviously other, cryptocurrencies out there. So while it's not Bitcoin, but other currencies are available. But at least Bitcoin works in a way very similar to how gold works. So Bitcoin in a lot of ways is almost like digital gold, except that adoption obviously has not yet happened at a wider economic scale. I mean, with gold, especially in periods of strife, you can always, mortgage your gold and borrow against it and, get something out of it. Obviously, it has a much longer history. There's something also known as an SDR basket, which is really a basket of currencies, which is being floated by the IMF for some time, and that down the road is proposed as one of the alternatives if the world were to move off the dollar standard. Maybe some way away from all of that happening, and I'll touch upon those parts down the road. Another important concept is something called stablecoin. I think the classic example of that is what Facebook is trying to do with Libra. Now, stablecoin is a bit of a difference in the very concept of currency, because if you recall, one of the things I was mentioning about currencies is that it's always one against the other. So if I'm borrowing, if I'm looking at dollars, then and the dollar is going up, then obviously a bunch of other currencies are going down. So it's like a seesaw kind of thing. But the stable coin is a little different, because what you really do is create an index of currencies. So let's say a stable coin would have 30% in dollars, 20% in euros, 10% in yen, and so on. A whole bunch of currencies it may have. So if the dollar goes up against the euro, fine. The dollar weightage may go up and the euro weightage may come down. But the overall value of the stable coin does not change much, and hence it's called stable coin. Now, this has a lot of utility when it comes to cross-border transactions, especially, for people who are dealing with this on a day-to-day basis, like, importers, exporters, and all of that. Because then their treasury departments don't have to worry so much about, what will be the forward rates on the currencies and their receivables, the shipments coming down the road or something, some money they're supposed to receive 8-10 months out. They don't have to worry about all that, because the whole basket is a stable basket. That's kind of what Libra is really trying to do. So a lot of this is taking, finding importance today because of this uncontrolled sort of, or at least seemingly uncontrolled money printing and all that which is going on, which obviously over a period of time creates issues with currencies. And we'll kind of go into that in a little bit also. Because let me just go into how the money system works first. I described it briefly with that HDFC Bank.
Debashish, question.
Yeah.
Why do they say that the reserve currency status of dollar could be in danger because of CBDCs? What's the relation between the reserve currency status and the digital currency?
So that will be an important part of what I talk about down the road. So just hold on for a bit. Okay.
Okay, great.
Yeah. So let me just describe how this money creation system works in the economy. I referred to it multiple times that the central banks are printing money. But what really is printing money? Because the central bank also has a balance sheet. There is an asset side and there's a liability side. So when it's effectively, at least so-called printing money, it's essentially increasing its own liabilities. Because if you look at a currency, it'll always say that, whatever the issuing central bank owes that much money, say $5 to you or whatever the currency is. So it's effectively increasing its liability when it's doing that. But if it's increasing its liability, it has to balance it with an increase in assets on the other side. So what they do is they print a bunch of money. Let's say they printed $1 trillion of money. Then with that $1 trillion, they go and buy government securities on the other side. Let's say US government bonds on the other side. So what that does is, obviously somebody was holding those government bonds. It could be the government itself, the treasury of the government, which is issuing those bonds. So that the treasury just got $1 trillion to play around with. Or it could be banks also, which were holding all these bonds. And then they sold, which was picked up by the central banks who were printing money. And the banks therefore get a lot of liquidity to play around with. Now, what do they do with that liquidity? They could lend it into the economy and create, credit growth. Credit growth is obviously useful because it provides financing to businesses, whether large or small, to go ahead and undertake all kinds of operations. You have short-term financing, which sort of helps to keep the engine running for any company, and then you have longer-term financing, which is used for building long-term projects and things like that. So all of this helps to grow economic activity, at least theoretically, and which in turn then creates value in terms of increasing the worth of companies, increasing the profits, more money circulating around, more people get money as a result of which in turn obviously increases the amount of money people can put back into banks, and that money can again be recirculated, because just going back to my HDFC Bank example, if companies, instead of employing 1 million people, can employ 10 million people, then that many more people have money in their accounts. So that money, can then be recirculated and more loans can be generated out of it. So essentially it's a brilliant sort of, compounding avalanche, almost you could call it that. And this mechanism, what it really does is that it takes a few $1 trillion, because that's what the central bank balance sheet is. Let's say the Fed balance sheet today is about $7 or $8 trillion. It takes that $7-8 trillion and transforms it into hundreds of trillions of dollars of money, simply by this constant credit creation in the banking system, which keeps happening. Okay. Of course, it doesn't necessarily all have to go into banks. Somebody may have sold a bunch of those government bonds and gone ahead and bought something else with it, and you could transact in a whole bunch of financial markets, and other things also can increase in value. So it grows the entire system as a whole. This is one of the big reasons also why we can't, just why they're doing the money printing which they're doing today, because when parts of the economy is shut down, you don't have a choice but to pump money into the system and ensure, that despite certain businesses shutting down, the economy doesn't come to a halt. Because otherwise, the several $100 trillion, because a lot of it is loans. So a lot of these loans could go bad. And because the several $100 trillion is only backed by a few $1 trillion originally, which then just, got circulated and loaned and reloaned and so on. If something goes bad in somewhere in those several $100 trillion, the repercussions down the chain will be intense. To stave off that complete collapse of society effectively, if that happens, is why they're doing what they're doing. So it's not completely irrational printing of money they're doing. What they're essentially trying to do is to prevent a complete Armageddon happening, and hopefully the economies recover and they're able to grow their way out of trouble. I mean, that's at least the bet. So that's how at least the system works. But there's something more to it than that, which is, I refer to the dollar being the reserve currency. Now, the way the dollar system works, now the reserve currency is extremely important, because a lot of transactions around the world are denominated in the reserve currency. So which means that if I am buying some shipment from Russia, let's say, we would do the transaction in dollars, even though the US has got nothing to do with that transaction. But the Russians won't accept our currency, or the other way around, we won't necessarily accept their rubles. So by force, we end up using the dollar, because both of us have faith in the dollar. That's the reason. I mean, that was a big reason why that whole petrodollar thing and all that also came in. So essentially, the fuel which is running the entire world is really dollars all around. The estimate is more than 70-75% of transactions globally happen in dollars. Okay. But this creates an interesting situation, because the way this whole dollar system works is that there are dollars within the US and there are dollars outside the US. There is a term called euro dollars, which is referred to dollars outside the US. It's different from the euro. Don't confuse the two. Euro dollars is simply dollars which is sitting outside the US. Okay. Now, in case for whatever reason economy is shut down within the US, some situation happens, etc., because of which all this, that previous slide, the way I had explained, this whole massive umbrella on top of that little seedling below of few trillion supporting several hundred trillion, that can fall apart. But of course, because it's in the US, the Fed can print money and try and plug the holes which have developed. However, outside the US, it's not so easy to do that. The Fed can't just print money and give it to them. The Fed can't theoretically print money and give it to, some company in Europe or some company in the US, or sorry, in Europe or Russia or wherever it may be. It won't do that. There are few things which can be done. The Fed can open something called a swap line with a central bank, which really means, let's say with the RBI, the Fed is loaning it some dollars. The RBI in turn is keeping some rupees with the Fed. So the RBI has some dollars to play around with. Why does the RBI need dollars? It may need it to buy oil. Some of Indian companies may be needing dollars to repay the dollar bonds they have issued. Remember, I was mentioning how people prefer lending in dollar terms rather than lending it in the local currency terms. So a lot of loans are in dollar terms. So, so these swap lines, what they do is, because there's a shortage of dollars going on all around, by giving some dollars to the RBI, for instance, then the RBI doesn't have to go hunting in the markets to buy dollars. It just gets a bit of dollars on loan. So it's, the whole market then climbs down. Because if the market knows the RBI or the bunch of other central banks are coming in to buy dollars, the markets will also be front running these central banks and buying these dollars before the central banks come in. And hence they bid up the price of the dollar. So to prevent all that, the Fed can just, open these individual swap lines. Alternatively, some banks can also supply some of this. Well, let's say a JP Morgan can borrow dollars within the US and then, create issuance out of it, create a loan out of it, which is then, given out in another part of the world. So they can do, it's a slightly complex process, but broadly, that's what they can also do over there. Okay. But yeah, there is no immediate fix to, you can just print money and supply it over there. Apart from this, the second thing is, a lot of these transactions globally go through something called the SWIFT system, which is like, an interbank sort of system of transferring money. Now, the SWIFT system, again, while it's not American, but it sort of gets routed through the New York Fed for a lot of things. And effectively, the US is able to control the operation of the SWIFT system. So net, what that really means is that the dollar is dominant both in terms of, or sort of gives extraordinary power to the US, because the rest of the world needs that currency. And that's why they can afford to print a lot of money for a lot of time and go on with it, simply because as a reserve currency, it is needed by everybody else. It also kind of gives the power of this, going back to, that question which you had asked, that in 1971, how were they able to, get out of the gold system? I mean, this is the real reason why. Because the power this gave it in terms of what money they could create and control the world with it was something which, as long as the quantity of money they could print was controlled by amount of dollars, they could never have got this far. So that's really the real thing behind it. Which of course means, and also, the medium of exchange, which is, that's what the dollar is being used for. And the system through which this exchange happens, which is the SWIFT system, is also something the US controls. So this gives it extraordinary power over money flow around the world. And that's immensely important. Okay. Now let's come back to that derivatives thing, which I was describing some time back. I was telling you how the origin of them came, whereas, you were getting that shipment of cotton 3 months down the road. So somewhere you had to, put in place a price today, or decide on a price today for the shipment down the line, so that, you could actually have a commercial transaction happen. how this thing sort of has ballooned into something else altogether is a result of an act which happened in the 90s. I mean, the act actually existed way back in the day, and this is connected to the whole money creation system. This was known as something called the Glass-Steagall Act. So the Glass-Steagall Act, what it had done, it was created in after 1929 when that Great Depression and all happened. So after that, this law came in, which basically said that you have to separate central banks, you have to separate commercial banks from investment banks. Now, commercial bank is something where you and I are putting our money in. Okay, we are depositing money. So it's a deposit-taking institution. So it has a certain fiduciary responsibility to the people who are depositing money with them. On the other hand, you could have an investment bank which is trading, multiple markets around the world, and it's doing it for its own, for its own account. It's got nothing to do with any fiduciary responsibility to anybody else. Now, if the same entity can take deposits and can trade wherever it wants around the world, then what it really does is it has access to a lot of low-cost money. Because when you're a deposit-taking institution, effectively you can borrow money at 3, 4, 5%, right? Let's say, or whatever the rate may be in any economy. So if I just take the Indian example, HDFC Bank is able to take money from you at 3, 4% for that FDs you are putting in for 1, 2, 3, 4, 5 years. If HDFC Bank were to go borrow money in the bond markets, it would not be able to borrow at 3, 4%. It would have to pay 8%, 7% or something to borrow that money. So there is a difference between the cost of funds which an HDFC Bank is able to get, or any bank really, any deposit taking institution is able to get. Now, if it's able to get money very cheaply, then its trading desk, which is trading things around the world, can really have a big party, because you're able to raise money at very low borrowing costs, which means you could just have $10 and you borrow like $90, and you could deploy it somewhere around the world where, let's say, you're borrowing it at 2% and you're able to deploy it at 10% somewhere else, even accounting for whatever risks you might have to undertake. You're making a clean spread. Now, let's say you're generating between the 2 and 10, you're making an 8% spread, but it's 8% which you're generating only of $10 of your own. Your $8 you're generating on $10 of your own, and you're effectively making 80% return on your money. So the returns are just stupendous if you can do that. So this, which means that it actually will encourage a lot of speculative activity, because it's just so good to do it. So this Glass-Steagall Act, which was put in place to prevent this, that got repealed in the 90s, which meant that suddenly the floodgates opened up completely. That meant that there was a whole bunch of mergers which happened in the US around that time, because a bunch of banks were merging with a bunch of investment banks, because investment banks had a different skill set, commercial banks had a different skill set. You merge them together, you got low cost money, and you could trade that money around the world and make a lot more money out of it. And that massive credit creation started happening because of it. And credit creation is not just about issuing bonds and all that. It is about issuing different type of derivatives as well, because those, once you start getting into those, just like our cotton contract, which was a contract between, say, me and another seller in some other part of the world, you could get into contracts with multiple institutions around the world on a one-to-one basis and create all kinds of, terms and conditions within it, which are, mutually helpful for both parties, and put a lot of leverage into it, because, you get access to easy, low-cost money, and hopefully make a lot of money doing that. So because of this, the amount of financial assets in general and derivatives in particular has absolutely exploded after that. And it's something I'll come to in a bit, to the extent that today it's really like the black hole, because this market is extremely opaque. Large parts of it, it's not, because it's a lot of it is one-to-one markets, so we won't really know what the kind of contracts are entered into, but the size of the contracts are so large that we simply don't know what's going on. Classic example of this is the financial crisis, which happened in the 2008-2009 period. what was basically, just borrowing, lending money to, say, worthless borrowers to go and buy houses with it. Let's assume that problem was a $100 problem. By the use of derivatives, essentially a lot of side bets were put on that, whether, the people will pay or they won't repay, and, what will happen to the bonds and things like that. So on $100 of the original amount, maybe something close to $10,000 or even more of side bets were placed on it, which almost meant, that the whole thing got inverted the other way around. And these side bets were all using the derivatives markets. And therefore, you had all kinds of, issues which happened once things started blowing up, or when the default started happening in the housing markets. Had it just been, issues in the housing market, the quantum of money was not so much, which would have created the crisis of the sort which it did end up creating. Let me just touch upon the different types of derivatives. We won't go into too much detail, but just sort of to touch upon it. The forward contract was what I was mentioning, like that cotton thing, 3-month contract, which we got into, the origin of it all. A futures contract is exactly like a forward contract, except that it is traded on an exchange. So once you put something on an exchange, then you have to put certain standardized features behind it, because then anybody and everybody could be borrowing. So everybody can't start getting into a different terms and conditions of a contract on the exchange. Is just too complicated to execute. So you just standardize certain features, and that's what you see as, let's say, something like the S&P futures, or in India, you have, all the whole futures markets, which you see. Then you have got something called options, which, obviously the most common one, which everyone would be familiar with, would be stock options that you may have in your various companies, which is essentially just an option to buy that stock at a certain price called the strike price, so that you can participate on the growth of the company down the road. It's effectively, easiest way to think of it is actually as insurance. It's an insurance against either the prices moving up or even the prices moving down. So like in insurance, there is somebody who's selling the insurance, and then there's somebody who's buying the insurance. The guy who buys the insurance will pay a premium. The guy who's selling the insurance will pocket the premium, and he'll just hope that the 100-year flood doesn't happen altogether, so that he can keep pocketing some money away for a long period of time. And that's exactly how this market operates as well. And then we've got something called the swaps market. If you recall, I was mentioning something called swap line of the Fed, where essentially it was swapping dollars for, let's say, rupees or something like that. A very common sort of swap market transaction which really happens is, let's say, if I have a liability which is, for my house, where I'm paying a certain rate of interest, and that interest can go up and down with the interest rates in the economy. So that's called a floating rate, payment which I have to make, because the interest rate can float up or down. Now, I don't want to take that risk of the interest rate moving up at some point down the road. I mean, I'm obviously happy if it moves down, but I don't want to take the risk if it moving up. So what I could do is I could enter into a transaction with another party where, I would pay a certain fixed rate to that party, and that party in turn will, take on the liability of my floating rate in this thing which is there, and pay that. So I've just converted a certain amount of uncertainty which I have into a certainty, where I know this is exactly what my outgo is going to be. So it makes it easier for me to plan. So very, very common type of instrument which is used worldwide. Now, when we come to the swaps market, or even, various parts of the parts of options market, which you obviously see on the exchange for those of you who trade options. But then there are lots of it which are not seen also. These are known as exotic options. There are all kinds of structures and all in it. So a lot of that happens over the counter. Over the counter really refers to the fact that you're basically transacting one-to-one. So these swaps market, these exotic options, a lot of them are done on one-to-one basis. They're done largely between institutions. It's like, it's like that high roller table in a casino. You need to really be at a certain size to be able to play in that market. And you need a certain license called an ISDA license to play in that, and all that is immaterial anyway. But that's the massive, massive part of the market. And point is that we really have no information about it because they're not really publicly disclosed around, because these are, one-to-one private contracts, so we would not know, but it has huge implications on financial markets as a whole, because somewhere or the other, a derivative basically is linked to some underlying thing. So if I'm issuing a contract, which is whether it is, converting some bond of a floating rate into a fixed rate or something like that, it is linked to interest rates or bond markets somewhere. Or if I'm entering into another type of transaction, another very common type of transaction is, let's say I get into a contract with a party, which to say that, okay, I'm going to pay you, say, an interest rate of 3% or something, or, let's say like something linked to a common benchmark like a LIBOR or something like that. And in return, that party will pay me whatever is the movement on the S&P 500, let's say over the course of the year. So we could enter into a transaction worth of $100 million, where whatever the S&P 500 moves up in a year, they'll pay me that much. So let's say it moves up 10%, it will pay me $10 million. In return, I'll be paying it a certain rate of interest, which is linked to, whatever the interest rates are in the economy, say 3% or something, I'm paying it. So say I'm paying that entity $3 million. The entity, on the other hand, is, keeping some money with me as margin, which could be a few $1 million here or there, for, whatever future liability comes up. And then let's say a year down the road, if the S&P already moves up by 10%, then effectively on my 3 million or 4 million or whatever it is that I paid, I'm making $10 million. So that's a fantastic return on my capital. On the other hand, the other guy isn't exactly doing charity either. So if he's taking money and, giving me a return commensurate with the S&P 500, chances are it would have done a reverse transaction with somebody else and essentially almost act like a bookie or a market maker. It's known as a market maker. So they'll almost act like a bookie who's giving a two-way kind of thing. And he's able to offset this transaction versus something else and capture that difference in between. So, which means just for a few $1 million, you're able to get a $100 million transaction. So this is very, very common. And because of this, it really is sort of creating a monster, which I'll just come to in some time. We'll touch upon that in the current status. So coming from here into, take a little divergence again, because gold is again a fairly big one. And what I'll try to do here is a concept I talked about a little while back, but just link real yields with gold, which kind of gives you a way to evaluate whether you want to have gold or not, and also link currencies with gold. So the way gold works normally is that whenever real yields, which is that printed bond yield minus inflation, when the yield is negative, it makes sense to own gold, because gold by itself does not pay any interest. But if your real yield is negative anyway, why not own gold? And on the other hand, if real yield is positive, then I'd rather just own the bond and I won't own gold. So the times for you to own gold is when real yields are negative, and times for you to not own gold is when they're not negative. Of course, that does mean that which currency are we talking about in which we are capturing this real yield? That's important. And that is then linked to the second aspect of gold, where over the centuries, it has acted like an alternative currency, a store of value, a medium of exchange, and so on. And therefore, if there is a chance that you are losing faith in your currency, then you would put money into gold, or as things are happening today, you may also put some money into Bitcoin. Okay. Classic examples where all this has already happened is countries like Zimbabwe and Venezuela. Certain amount of that is happening in Turkey today. And it's possible down the road this could happen all over the world. Okay. So when we get into this phase where we are worried about currency, the existence of the currency only, fundamentally, then it doesn't stay as a normal market anymore. It's a lot more driven by fear, because if you're fearing that your currency is completely going to lose value tomorrow, it almost doesn't matter what price you're going to pay for the gold that you buy. You'll just buy it because you're worried about your net worth really going to zero. So even if you had to pay a certain cost to do it, you will do it, because at least that way you get to preserve some of your net worth. So that's a sort of behavioral aspect which comes in. And then the third part is more a shorter term relationship, which is more dependent on the kind of demand and supply for gold at any point in time. Now we spend a lot of time thinking about physical demand, which is India or China buying physical gold or not, but that only is not such a big part of the overall demand. There's also the demand, the physical demand also happens from central banks, and that's been a big one for the last few years, especially where central banks have been buying gold, diversifying their reserve assets. But another part is money which is going in, let's say, into ETFs, or money which is traded in the gold futures markets. So if you're buying, ETFs also a lot of times they buy futures on gold. Remember derivatives, which I touched upon here, futures. So yeah, so money which is going in into the futures markets of gold, that also has an impact on gold, because if the futures price becomes very high because of huge demand in the futures compared to the price of physical gold, then someone called an arbitrager will come in, who basically will sell the futures price. He'll buy the physical gold and hold it till the maturity of the contract. At the maturity of the contract, the prices of the two will converge, because at the maturity, the futures price will equalize to whatever is the physical gold price. So they'll just try to capture that. So the actions of all these market participants ensures that there's a strong link between the futures price of gold and the physical gold price. So therefore the futures price can be a big driver for demand for gold, or even the supply of gold, which is happening at any point in time. So all of these factors impact each other. There's a term called reflexive, which what it really means is one impacts the other, but one's impact on the other in turn impacts the first one back. And that's how, like you have this two-way relationship, which is constantly in play, or actually not even two-way, like a multi-way sort of relationship, which is in play. And that determines the price of gold at any point in time. This is a chart which is just comparing real yields with gold, and we've just taken again US 10-year just as a representative. So if you recall, what I was saying was, if real yields are negative, then you would own gold. If real yields are positive, you would not own gold. So therefore, if I just invert the chart of real yields, they should essentially positively correlate with gold. And that's what we've just done over here. So if you see the close linkage between the two. So in normal circumstances, this is what determines how gold behaves, which then bears the question, when do we get positive real rates? When do we get negative real rates? We get negative real rates either at times when inflation is running very strong, or even times like now where the inflation isn't particularly high, but the bond yields are even lower. They're next to zero, or in certain cases, they're even negative, which means when I still do A minus B, which is bond yield minus inflation, I still get a negative figure. It's not that I actually have inflation, but it's just a little higher than where the bond yield is. On the other hand, when can I get a positive real rates, which is the not so good scenario for gold, is when we get a deflationary scenario. Deflation means negative inflation, which is when bond yields come down, but they may not be falling as much as the speed at which inflation is falling. And therefore, the difference between the two is a positive figure. And that's when it doesn't make sense to own gold. Okay. Let me also interlink a few things between currency markets, monetary policy, and gold, which kind of gave the reason why gold made a high in 2012, for those of you who might have been active in the gold markets at the time. Gold had been rising for a while, especially post 2009 to 2012. There was a strong rally in gold because the Fed had started doing money printing. So there was obviously worry about inflation happening down the road because of all this money getting circulated around and printed and circulated and so on. But in 2012, something changed, which is that Shinzo Abe got elected in Japan, and he came in and reversed their currency policy. Now, why this was important was that, till then the yen had been appreciating. He just said this is too strong and we need to create some growth and we need to create some inflation within Japan. So instead of a stronger yen, we'll have a weaker yen. Why this is important? Because Japan is a big player in the export markets, and it competes with the likes of Germany, China, Korea, and all, which is the important exporter nations, whether we talk about the Eurozone or Asia. And if one exporter nation is reducing its prices because it is reducing the currency value, then the others don't have much of a choice. They also have to find a way to match it. So all of them effectively then started depreciating their currencies, which meant the dollar really appreciated against all these currencies at the time. But the net effect of all that is that export prices from Japan came down, let's say cars or whatever it is that they were exporting, which caused export prices from multiple other competitive nations also to come down, which meant that a deflationary effect was coming into economies around the world. But this was a time when investors were positioned for more inflation down the road because they were worried about money printing and all that. But a deflation was suddenly coming in. So you were positioned exactly wrongly for where the world was going. They were positioned for inflation by buying things like gold. Essentially, real yields were negative, so you buy different things. So they bought gold, they were buying emerging market stocks, they were buying this thing called inflation protected bonds. We won't really get into that, but buying all these kind of things. So all of these sold off at the time simply because something changed. We're building into something similar today, but we're not quite there yet. And that's why I'm kind of just highlighting this interlinkage again between multiple markets. Okay. So from this, let's just come to the current situation. Okay. Amit, we're probably running pretty late, right? So maybe the interactive part will probably be more one way than interactive. Is that okay?
Yeah, I think do one way, so it's okay. Just finish everything and give us your insights, and then we'll open it up to questions.
Sure. Okay. So so let's just come to the present. Okay. What have we seen really is, of course, in February, March, stocks had a big fall and all that. But I think the more interesting story is what was happening before that. So if we see before that, from 2018, the left side is the bond markets. The bond yield in the US, this was the 10-year bond yield, which is really representative of bond yields around the world. And the chart on the right is the S&P 500, which is again representative of equity markets around the world. I mean, I did mention that, US markets are doing much better than the other markets, which is in terms of actual returns, but the direction of movements are largely the same around the world. So yeah. So if you saw this, and especially if you look at this highlighted portion in 2019, 2018 and so, you see that the bond yields are coming down quite a bit. What it really means is that interest rates in the economy are coming down. Interest rates in the economy are coming down because the longer term economic prospects simply don't look all that good. And therefore, the market is anticipating growth isn't going to be that much, inflation isn't going to be that much, so bring down the rates. On the other hand, stock markets, if you see, are by and large rallying. So the bond markets are telling you something on one direction and the stock markets are saying something else altogether. Now, if you were a central banker, you would look at the bond markets and you would say that, okay, I mean, these guys had been reducing interest rates at the time, but you would look at this and say that just reducing interest rates isn't cutting it. We've got to do something more. We've got to give some extra juice, some extra steroids we have to fit in, because we've got a terminally ill kind of patient over here. But the stocks are still going very strong. Unemployment is pretty low. Sentiment is pretty positive. Equity markets tend to be fairly closely linked with sentiment. So sentiment is fairly positive. So how do we justify doing all this actions? So in some ways, you were almost wanting that some kind of crisis happens, because if a crisis happens, then the reaction to a crisis, the reaction function is that, I can get away with doing all kinds of measures, which I would have wanted to do anyway, but I just wouldn't have the justification to do it. So now they could do it. Now, we wouldn't necessarily have been anticipating a COVID would have happened or not, but you could almost read it from this that something was about to give. Okay. Which now brings us to what's going on right now. And I was mentioning how the derivatives market has become a black hole and all. But to get there, let's just look at what the global markets actually look like. Okay, the total value of stocks around the world, which is like the collective market, it's known as market cap, you know, like the market value of any company. So if I look at it collectively, it's about $80 trillion worth. If I look at GDP as a whole, it's again about $75 trillion worth across the world. On the other hand, if I look at bonds which are out in issuance, and I mentioned how, you know, the amount of corporate bonds had been increasing in supply because, you know, people were wanting higher yields and all that. So that's about 3.5 times of that amount of stocks which are out there, or, you know, of the total GDP which is there, about 3.5 times of that. The bonds are worth about 3.5 times of that. So which means the amount of leverage is pretty high already. It's like saying I'm worth 100 and I've got loans worth 300. So obviously I'm quite levered, but that's not it alone. If you add real estate to it, which also has significant components of leverage built in, that's even bigger, about 300 trillion. Currency markets, which again tend to work on leverage, even bigger. And then you've got these derivative markets, all those examples which I was giving you of those swap transactions and all that. And that is probably north of $2 quadrillion. It could be much more than that, and we simply don't know. So net, if I combine all this together, the total amount of leverage is not just 3-4 times, it's about 15-20 times the total world GDP. So that similar example of a few trillion getting converted into hundreds of trillions, or even, you know, thousands of trillions effectively of leverage which is there in the system. So this is one big reason why also you can't just replace things with gold tomorrow, because the amount of gold in the world is only worth $10 trillion. So if you were to replace things with gold, everything else would just automatically collapse, and there'd be complete anarchy. So you can't really just go there, you know, in one way. This is the part which I touched upon, where, you know, that the dollar is exceedingly important when it comes to transactions around the world. More than 70% of transactions happen in dollars. When that whole Bretton Woods and all of that stuff was happening, at that time, the US was more than 40-45% of world GDP. So it made complete sense for the US to be, you know, the dominant currency. But today, where it's less than a quarter of world GDP, that case is not so much anymore. Emerging markets are far more, you know, becoming far bigger in, you know, overall size. So this kind of a skewed relationship is a problem. Now, if you look at it from China's context, this is a particularly big problem, because the yuan is used for barely 1-1.5% of transactions globally, which means they are massively dependent on the dollars for any interactions they have with the outside world. We all know China is a big exporter, so any interactions, they're massively dependent on dollars. And secondly, if you recall, I mentioned that things moving through the SWIFT system can be controlled by the US, which means that if the US wants to shut China out of the dollar system, they can do that. And that's a massive problem for the Chinese. And they will never be able to achieve true superpower status unless they do something about it. How are they planning to do something about it? It's a combination of factors. When they do this Belt and Road Initiative, it is effectively like economic colonization and getting possibly that country where, you know, you get them indebted and then you get them transacting in your currency. But that probably only ensures the supply side of materials to them. It's harder for them to impose that on other countries which are on the other side, whether it's the Indias, the Australias, Japans, US, etc. of the world. What they're trying to do is another experiment, which is they're one of the ones on the forefront of trying to work with this central bank digital currencies, which, you know, they're using the Alipay and the WeChat systems to, you know, test it out and hopefully spread Alipay and WeChat all around the world and essentially get people to, you know, buy and sell things on it, and therefore get more people transacting on their currencies and progressively shift more and more of the transactions onto yuan over a period of time. But that's their play. It's not something they can do overnight for various reasons, but they're also getting into desperate situations. So should a situation between the US and China escalates, to expect the dollar will get weaponized. But that's another big issue with the world today. These are the two big issues which are out there. One, the sheer amount of leverage, and two, the fundamental disbalance in the currency system. And from that, let's come to another concept, which is the cost of money. The cost of money is really nothing but the interest rates we were referring to. But the second part is the quantity of money. When we refer to quantitative easing, what you're really doing is increasing the quantity of money. So the central bank was increasing its balance sheet like how I was describing over here. So quantity of money is, interest rates are already down to zero. So how much more can you really cut it? You really can't. Okay. So what becomes exceedingly important down the road is how they play around with the quantity of money. So with this, let's kind of look ahead, and we'll kind of have this, little complicated looking framework out there. But what I'm really evaluating broadly is that on one side, one is trying to assess what is the kind of risk appetite which is there. What's really meant by risk appetite is that, if you just think of yourself as an investor, there are times when you feel scared about what's going on, and then there are times you feel very confident about what's going on. When you're scared, typically you will not be buying anything. When you're confident, you may be buying a lot of things. Now, whether your actual act of buying is happening at the right time or not is another matter altogether, but your attitude will change. And this collective representation of this attitude is what is the risk appetite which is there in the markets. A lot of times, something which is done well tends to give the perception that it is less risky and more people buy into it. And in fact, something called greed also starts playing in. And, as a result, more and more people climb in. When you hear more and more people are coming into something, it gives a bit of reassurance. And this is not just to do with individuals. This happens a lot with institutions as well. Because when you're a professional money manager and you kind of know that, you're invested in an Apple, you know that at some point Apple is going to break and it'll fall, the price will crash. But the important thing is you are not the only one invested in it. Every other manager on the street is also invested in it, which means while it is guaranteed that when it falls, it'll fall in a big way, but you will not lose your job because of it, simply because you bought Apple, which is a great company, and everybody else on the street also bought Apple. So you're not going to lose your job. Whereas if you went and bought something random and that stock blew up, there's a very high probability you would lose your job. So that's how investor positioning and risk appetite plays a big part in how markets work and how stock prices or any other asset prices move up or down. Then you've got something called the fundamentals of it, and I'm referring to it as fundamental perception because nobody really knows what's going to happen in the future. You have a certain perception about how the fundamentals of the companies shape up. Now, when it's a question of perception, people can have different perceptions. But by and large, there'll be a sort of normal distribution which will happen, and a bunch of perceptions will, concentrate around one level somewhere. So that's broadly called a consensus view. Now, as an investor, what you're really looking for is to what extent do you think the consensus view, which is what many people seem to believe in, is that already reflected in the stock prices today or whatever asset prices today? And secondly, to what extent can that view be wrong? What can change things? Because everybody's piled up in one direction. And if something changes, they will have to rush out of it. Go back to my gold example. Everybody piled up in gold in 2012, and the reality changed. So they had to rush out of it and cause the collapse in gold prices. Then on the other side, you've got how is policy shaping up? And policy, like I mentioned, is extremely important because a few trillion have got created into hundreds or thousands of trillions, which means if you let it go, we will basically have a Mad Max world. So you don't have a choice but to find some way to keep the system in balance, which is if you can't make money cheaper, print more and more money. And that determines the way policy works. But there's another part of policy also, which is fiscal policy. That is, monetary policy is what is done by the central bank, which is printing money or lowering the interest rate and all that. And fiscal policy is what's done by the government, which is providing SOPs or providing bailouts and all of those kind of things. So those play and will play an extremely important role going forward. And then the last part is really flow of money. Because flow of money is kind of linked to liquidity and all that. And as much as, we may think that an economic fundamental will shape what should happen, but the reflexive thing also happens. If a bunch of money flows into something, like I mentioned with that professional money manager example, the stock goes up, the size of the stock also goes up. You feel more confident investing into it because somebody else has also put their money into it. And therefore, the flow itself kind of becomes the driver rather than the fundamental itself. The flow can drive the fundamental really. And this can of course reverse the other way around as well. And you could have periods where, you know, these flows fluctuate a lot, which creates, you know, massive swings in the market up and down, which is called volatility. And volatility has its effect of, you know, shaking things up. Sometimes you know, get scared out of your position because of volatility and all. So it plays a very important part again in investor psychology, which in turn goes back into risk appetite. So basically you've got this convoluted one factor affecting the other kind of quantum theory, which kind of goes on. Okay, no one thing, if you look at it in isolation, is ever going to give you the complete answers. It is always a mix of things. Okay. There's something I wanted to go through, but what I'll do is, you know, in the interest of time, I'll really come to the conclusions so that we can kind of, you know, move forward from there. Now, this is something I actually published back in April, May. So it'll kind of give you a bit of idea of how I'm thinking about this. So when we were around that April, May period and all, yeah, I mean, the economy was short. You know, obviously lockdowns were there, a bunch of businesses had shut down and or whatever, you know, we weren't going out to offices anymore, going out to malls and all of that stuff anymore. So yes, economic fundamentals were bad. So you would imagine normally that, okay, stock markets should fall. Normally, yes, that is what should happen. But the few things which played here. Firstly, the stock markets had already fallen in March, you know, February, March itself. So investors were already having a very low risk appetite. Secondly, what we have to see is what is changing in terms of policy, in terms of some of the other aspects I mentioned, like flows and all that. And what is it? Is there a certain different perception about the future which can happen because of it? So let's start with policy. Few things which they did. Of course, they printed a lot more money. I mean, that of course was the start of it. The second thing which they did is they put in some, you know, basically these moratoriums on paying back interest. So call it moratorium, forbearance, you know, all kinds of words you can use for it. But essentially it meant you didn't have to pay back interest, which meant that the liability which you had got taken away, at least temporarily. So now if you were somebody with money, you then, you know, suddenly didn't need to pay that much. Your costs also probably came down because you simply couldn't spend it anywhere else. Everything is shut down. And lastly, you're at home. So, you know, you have more time. You don't have a boss looking over your shoulder to see what you're doing. So you've got a little more disposable money and you can go and do something with it. But you can't really spend it anywhere. So you may as well put it into the markets. So you had a lot of flows coming into the markets. You had risk appetite, which was already very bad, which meant any change would have meant people were just not positioned for it. They were already too scared going into that period. And policies from the authorities were also supportive of giving more, you know, fueling more liquidity, creating more money, supplying it into the system. So which is a perfect recipe to, you know, drive up asset prices because of liquidity coming in. It's not necessarily causing businesses to improve, but it is driving up prices of assets. So stocks have gone up, gold has gone up. If we go back to our real rates equation, interest rates are pretty low, inflation is slightly higher, so real rates are negative, so which is good for gold. You can apply the same theory for stocks as well, because if you know, apply it into that model, which I think Ken talked about, you know, where you discount future cash flows to the present. If your discount rate is basically that real yield which you're using, if your real yield is negative, essentially, you know, you can have things worth whatever you want it to be worth. So that drives, you know, this whole behavior when liquidity comes in and when rates are very low. But what we then have to worry about is that what changes. Okay. Now at that time, I was looking at a timeline of about August, September when things could start changing. Maybe that's got extended a little bit. We did see a bit of a correction, last month and all that, but I don't think that's quite it yet. Like I mentioned, there is a fundamental perception about the future, and then everybody starts believing a certain thing. The perception was a little different in March. It may be a little different today. And it may become a little more different if the markets are up 20% from where we are right now. If, even if we discover a vaccine, by instance, it may make things look even better. Whether it happens or not, we'll see. But that can potentially change the liquidity which is coming in. And that's really what is to look out for, because liquidity has driven a lot of these things, apart from the time and all that, and lack of avenues to put money in. If that changes, more things open up, more avenues to put money come in. If time reduces because you start going back towards office and things like that, and if central banks also decide the world doesn't need as much support, we can take some support back, then liquidity suddenly starts changing. So things could turn around the other way around at that time. Okay, it could be something else which drives it all together. It could just be a combination of factors like, what's just happened is last 2 years, a lot of money went into US bonds because the dollar was going up. US bond yields were coming down, which meant bond prices were going up. So a lot of money parked itself there. And then over the last 2 months, the dollar has been falling. So therefore, money parked in US bonds has been losing money. So they would have started taking some of that money out and putting it in other markets. So as that would happen, the bonds in the US would sell and the bond yield would start going up a little bit. And the dollar would fall because money is coming out of dollars and going somewhere else. So you have bond yields going up, dollar going down, and simultaneously you could have something like gold go up because of all the reasons highlighted. So if this continues for some time and the bond yields are a bit, relatively more higher than where they are today, dollar is relatively, much lower than where it is today, then you could have a situation where people start, putting out this theory that, the people are not having much confidence in the Fed, and that is why the dollar is falling. It may not, it may not be a reserve currency anymore, and the bond yields are rising. It's showing people are losing faith and all of that. Now, funnily enough, all of this has got created because of the support from the Fed in the first place. So what they gave, they can take it away as well. So these things can happen. That huge derivatives market, which I was talking about, bonds are used as margin in that market. So if bond yields are going up, bond prices will come down, which will mean that the value of their margin falls, which means they have to go find margins from somewhere else. That's a problem. So that can also create stress in the system. So I'm really watching for these confluence of events, which is yields going up, dollar coming down, and gold going up, to see where the change can happen. It may happen in 2-3 months or maybe, closer to just after the election or something like that. We'll see how that goes. That can take it into the next phase where the reality of what's going on really starts catching up. Because the fact of the matter is, COVID, what it has really done is just fast forwarded certain things which would have happened in any case. Certain things would have probably gone out of flavor in any case, and it's just got, pushed forward. And if your vaccine and all those things don't come, then of course there's a longer term economic problem, which we have for a while, till we get to that herd immunity stage, and that may be some way away. So suddenly, just like how we saw this massive catch up between the message of the bond markets and the message of stock markets, which we saw in February, March, that could happen in a much, much bigger way, say starting from somewhere around November, December, or somewhere there, it may start around that time. And you could have massive falls happening in all assets across the board, and which will create deflation. Inflation or deflation actually happens in two ways. One is in asset prices themselves, and the second is in the actual price of goods and services. In a world where the leverage level is very high, it is more important to actually inflate asset prices to keep stability. Because everybody's borrowed money. So against that borrowing, they would have kept something as collateral. If you keep your collateral values high, typically you've kept stocks, bonds, all of that as collateral. If you keep that value high, then you can continue the Ponzi scheme. If you don't, then you have a problem. So that's why, the value, asset inflation does matter. On the flip side, if you are worried about asset values, then there could be a massive asset deflation, which in turn causes economic deflation, because the banks, when they have lent money and they see that the collateral they have against it is falling, whether it's real estate, whether it's stocks, whatever it might be, they will start curbing their lending. Less credit gets circulated around the economy and it causes an automatic slowdown. So first you see asset deflation followed by economic deflation. This whole thing may take about a couple of years or so. When you have this kind of thing happening, people are struggling to pay back interest and all that. So typically your dollar gets benefited again, because so much of loans are denominated in dollars. So everybody's rushing to get hold of dollars to pay back if they can. The consequences of not paying back is also high, because you could be forced into bankruptcy and all that. So typically dollar does well and US government bonds tend to do well in that period. Now, recovering from that period will require a concerted effort, both by the governments and the central banks, where not just printing more money, you'll actually have to go create employment, because there would be massive unemployment which will get created in this deflationary phase. To create employment, you will have to, they'll do things like bringing supply chains back from China, building a bunch of infrastructure here and there. Now, you could argue how effective all these things are actually going to be down the road. At least temporarily, it will create GDP growth, it will create employment, it will do what politically needs to be done, because unemployment is a massive political issue as well. So when that happens, you'll obviously, all of this is not going to happen out of thin air. You'll have to do a lot of money printing to do this. And the budgets of the governments will have to expand, fiscal deficits will have to expand a lot, which means a lot of investors who have parked money into bonds, and say 40-50% of portfolios or more are in bonds, will start getting worried. Because if you recall, if you're doing all this, you can create inflation down the road. If inflation happens, then your bond yield also has to move up. Otherwise, the real yield will be zero, and nobody will be buying the bonds which you need to, borrow money. But if that's happening, and you're expanding your budgets and your fiscal deficits and all of those things, then you're worried down the road that the bonds will just simply lose value, because if yields move up, prices move down. So a lot of bond investors will start shifting part of their money out of it. Now, some part they may control by simply putting artificial restrictions on how high yields can go. Countries like Japan have already done this, but that then will start getting reflected in currency markets, because where you're restricting all these things, people will probably start losing faith in the currencies. So you'll see people shift money from financial assets like bonds and all that into real assets, because that's what typically you'll do when you're worried about what happens. Now, when you look at real assets, okay, what real assets to buy? Gold is an obvious one. You would do that. Now, irrespective of the state of the economy, you still need food and water. So you will start looking at agri-commodities, which have been a dead investment for the last 30-40 years, which means nobody is even positioned in these things. The largest ETFs of agri-commodities are tiny in size when I compare to ETFs on other commodities, because ETFs are like the go-to vehicle nowadays if you want to allocate money to a particular asset. If these big institutions, even if they park like 3, 4, 5% of their money into agri-commodities, the prices will simply explode. So look at that space. And then also with agri, what happens is the cycles are much faster, because all it needs is, high prices coinciding with some supply constraints, whether it's because of Corona, whether it's because of some climate change, whatever it might be, those things will come when they have to come. So that's kind of how the situation may develop. And then down the road, if you have to really create a lot of employment and all that, you'll have to do, bringing those supply chains back from China, infra building, blah, blah. You will need industrial metals. So you'll need to build all these things. So for which you need all these industrial metals. So those things will also go into a bull market. Now, there are a few things which will start playing as we get into the back end of this century, of this decade. One is that when all this big money printing is happening, it'll happen all over the world. So you could reach a situation at some point where a lot of currencies really become very weak against the dollar, and they really start hurting. Now, if you want to change from a particular system, like a currency system, you have to have consensus. If you ask today, is there any consensus to change from the dollar system? There isn't. Okay, so without a consensus, it's not going to happen. But if you have a situation where every other currency is hurting massively against the dollar, then the consensus can build, because even for the US, that's not a great situation, because so many US companies are global. If the markets they're operating in, those currencies are falling, then the earnings translated back into dollars really falls off. So it's not great for them either. And they suffer their own deflation as a result of it. So they will also want a weaker dollar at that point. So that can create a shift in the currency. Whether it shifts, whether that creates a new reserve currency thing or not, we'll have to see. It's possible that may happen. Should that happen, that we actually, there's a strong enough wave to actually have a new reserve currency or a basket of currencies or something else, then we could start getting repricing in a lot of commodities, very similar to the 1974 situation which I was describing, where the dollar had gone off the gold standard and this repricing thing created chaos. So how do you reprice gold? How do you reprice oil? How do you reprice other commodities? Because everything is priced in dollars today. And also if you're using them, there's a lot of need for them, and you know that it's going to get repriced down the road. You don't know whether that repricing is going to happen in your favor or not. So you'll pull forward your buying because you don't want to be caught out, paying a very high price down the road. So that will in fact even fuel the commodity boom further around that time, which could be around the 2027, 2028, around that whole period. So that's the way broadly through this decade things may play out. What it really means practically is that, whatever's continuing now may, run for a while, maybe a month or two is what I'm guessing. A few things will probably come together at that time. I told you the things I'm watching for, which is yield and gold and dollar. Then things could change. We may go into a big deflationary phase where, a lot of this unwinding happens, where dollars and bonds work. And then the new cycle which comes out of that, a different set of things will work compared to what has worked in the past. So I was mentioning how, in the beginning, that how every decade or so things keep flipping around. So that's probably what will happen as well. These kind of things, commodity companies and all have done literally nothing in the last 10, 12 years. So they might come back into favor. If industrial booms and all are happening in various places, simply because you have to go and build all these factories and all that, that can mean, a kind of companies which start working, which are known as cyclicals. These may do well, which have not done well again in the last 10, 12 years. So things could look very different from what we are today. So that in a nutshell is what we have for the world ahead. Putting it all together, I think, you've got a certain bit of action which happens in markets, which causes some, reaction on the policy front, or a policy action can create certain actions in the markets. It's a two-way relationship, which then can translate into, every country facing its own situation. Depending on how, a particular country responds to the issues which are at hand, you could have its currency behaving in a different way. The behavior of currencies in turn can create issues of faith in the central banks of that country. This will probably become a big factor going down the road, and which really leads us to really the question of, which part of the matrix are we in? I mean, what is illusion? What is not? All of that philosophical concepts really start coming in, because what we have today is in some ways a bit of a money illusion, where, a few trillion has basically created hundreds of trillions, and which is why all of this has happened. How long that illusion lasts and what it translates into, we'll have to see. So without getting into the metaphysical aspects of it, we'll sort of wrap it up over here. So that's it from my side. I hope I have not put you all to sleep.
Great.
Take questions.
Great presentation, Debashish. I'm sure there's so much to unpack there. That every concept that you mentioned, I had to think about again. So some questions. It's open to questions, so feel free to ask. I don't have the entire chat log. I'll say some things that I remembered from the chat log. So one question, Debashish: should we be buying gold?
So let's go back here. Where did I go? Yeah, visible?
Yes.
Yeah, this is visible, right?
Yes.
Yeah, so we might be in the final innings of gold in this phase, this hope phase, which I'm describing, which could cause it to go up. I mean, it's at whatever, 1900 odd right now. It's possible it goes up to about 23, 2400 or somewhere there. It's when I put in these targets, there's nothing sacrosanct about a target. It's really about how long a particular phase is lasting. So in that phase, that can happen. But when we get into this deflation phase after that, gold won't really work in that. Only the dollar and bonds will work. The gold will fall because gold, as of now, will still work on the basis of that real yield equation. So while the real yield is negative, it's fine. It is not so great. But gold overall, I think, is in a bull market, which will mean it will go through some big correction. In every bull market, you have a certain initial interest which happens, things really, pick up, and then you get a big gut check in between. Where a lot of people who came in, especially who came in towards the latter stages of the initial run, then, get shaken out. Because they may not necessarily have gone too deep into, the fundamentals of it, which is why they would have come a little later. They get shaken out in that phase. And then the new sort of, bigger bull market will unfold after that, because that's where the thing will change from the real yield being the only determinant to alternative currency being the thing. Because as I was describing, that where all this fiscal and monetary thing will happen, you will have genuine concerns about the viability of currencies, which is not really the case yet.
So yes or no? Yeah. Buy gold or don't buy gold?
So right now, if you buy, it will be a bit of a trading buy. So for those who have the wherewithal to trade it, for sure, go for it. But be cognizant that it's more a trading thing, and you could, it could maybe move up to 23, 2400 and then maybe fall 40, 50% from there. The fall will look so brutal that it could really, shake things up pretty badly. So be aware, such a thing can happen. If you can nimbly trade it, great. Otherwise, wait for that bigger thing where nobody, see, the best time to buy anything is when nobody cares. You may have to wait around for a little bit, but then you get great prices and then it moves up from there. Right now, a lot of interest is there. So that's really
okay. Next question. With almost everybody using debit card, credit cards, are they really printing paper money? So how does it mean? What does it mean to have paper money when everybody's using electronic money?
Yeah. So yes, I mean, it is effectively electronic money. Debit card isn't really new money creation in a way, because debit card is just using that same money you already have, right? But credit card is credit creation. So effectively, the issuer who is sort of, backing the MasterCard or whatever is essentially creating a loan. It's just like a loan, basically. So out of some base money, it is creating a loan on top of it. So it's that same thing which I was describing here. Few trillion getting converted into several hundred trillion. It's that same mechanism, how the banking system works.
So
you get a loan which is created. Yeah.
So in the current economy, right? Hardly anybody is going out and spending cash. But what we get in news is every country is printing money. So what is it in physical terms? Some cash is being printed, or it's just mentioned like that?
So just look at the right side, quantity of money. So what this is telling you is the central bank balance sheet, okay, which was, say, about 4 trillion or something up to March, which has gone up to about, this was slightly dated. By May, it was close to 6.5, 7 trillion. Today, it's becoming, closer to about 7.5, 8 trillion or so. Okay, so 4 trillion odd has become 8 trillion. So 4 trillion fresh amount of money has got printed. What that means, if you go back to this, is that I was describing that whole money creation thing. Central bank create money, increase their liabilities. So on the liability side, it has printed 4 trillion more. So it has to create an asset side as well in its balance sheet. So with that 4 trillion, it goes and buys government bonds or other things. Also, it has bought this time worth $4 trillion. So that money has gone into, let's say, somebody, whoever was owning that asset has now got that money. So that could be a bank which is owning that asset. So that then creates more loans out of it and gives it to somebody else. So that's how it works.
So really the mint workers are working overtime.
Well, they have to, because if certain parts of it fall, the issue is that, you know, if parts of the economy shut down, then the several hundred trillion is sitting on top of a few trillion base, right? If certain part falls, then everything will collapse. And you literally have riots on the street, and you have like complete, you know, chaos and rioting and all those things happening. Now, is that where you want to go? I mean, that's really what they're trying to prevent from happening, and that's literally what will happen. Now, the question is, why did we get here? I mean, is what, you know, this whole thing I was telling you about the derivatives market and all of that, this black hole which has got created, is because of all that which has happened. But now it's already happened. It's already there. Now, right now, even to support this, we have to print more money, create more debt. We have to do all that, you know, just to support people. This is just the reality of it. So will it unwind over a period of time? Of course, it will create problems, undoubtedly. It can be pretty bad.
So the way I was looking at it was that with so much debt in the balance sheet for countries, our future generations are going to work harder for that. Is that a correct statement?
Well, yes. I mean, they would. It's just what they're hoping for is to desperately find some way that, you know, things recover and grow and all that, so that you can grow your way out of the problem. If you postpone the apocalypse further and further, and you can find a way to grow your way out of the problem and slowly bring down the issue over time, then you may have a solution. If not, at some point you'll have a complete collapse of the system. It's possible it happens even quicker. All we can say is just hope it doesn't happen, but it may happen. I mean, it may happen. And in fact, the deflation phase, which I'm talking about, it will seem like the system is collapsing, although I really don't think it's going to be that bad, but it will seem like that. Markets will have a massive fall off at that time. Immense amounts of wealth destruction will happen during that phase. But
how far away is that?
Probably starting in a month or two, maybe. I can never exactly say, but somewhere there. Yeah.
So the world will crash by end of this year.
Well, it won't crash by the end of the year, but that's where it may start. The entire process may take 6-8 months for the bulk of the fall to happen. That we'll see. You know, when we get there, we'll see there. But that's broadly what I'm anticipating. Yeah.
Bose?
Yeah.
I mean, what happens to India? Can India really apply this solution of printing money?
So if you're not the reserve currency, you are a little, or, you know, you're not a currency which others want. You are a little restricted on how much you can do, you know, that money printing. They're all doing it. Everybody's doing it. Even we are doing it. But if you're a reserve currency, your benefit is that everybody else needs your currency. So even if you increase the quantity of money, it doesn't matter because everyone else needs that. So dollars everybody needs. After dollars, the next most important currency is the euro. So everybody needs it. But if people don't need your currency, then you're very restricted on how much you can do. So India, not that many people need our currency. So there's only so much we can do. The good part is our situation is not that bad for 2-3 reasons. Firstly, our derivative markets are nowhere as big as, I mean, we don't even allow half of those things. So our actual amount of leverage is nowhere as bad as what it is in the Western world. Right. Secondly, we also have a lot of gold per person. So that does provide, you know, that thing, and there are enough of growth opportunities which are there. So leverage versus growth opportunity is much more in balance in India. Having said that, there is obviously a massive population. So we have to get more creative of how to keep that population occupied, especially in a world which is moving more towards automation and all those things. I mean, it's not like jobs can't be created, but the skill level required will be significantly higher. And that's where, you know, the challenge we face, because if society breaks down, then all of that doesn't matter.
Thanks. So two questions related to INR. One is India gearing up for CBDC? And the second one is, will the INR get devalued further?
Okay. Yeah. So at the time, let me take the second one first. At the time when the dollar appreciates, which is in this deflationary phase, the rupee will also come down. I think that not necessarily because of very specific problems with the rupee per se, but if the broader basket is coming down, the rupee can't stay up. If I look at the actions of two important players, which is Mukesh Ambani and the RBI, they are almost indicating the same thing. Mukesh Ambani is effectively replacing his dollar liabilities with permanent dollar capital. So he's built all this stuff out, you know, the retail side and the telecom side and all of that, you know, on the back of a lot of dollar debt at low rates. Today he's converting that almost into private equity effectively, which means effectively he can just, it's permanent money. He doesn't have to pay an interest on it or something like that. And then the money which is coming in, also a lot of it is thanks to Reliance only. The money which is coming in, RBI is not letting all that money come into the economy, which would have meant otherwise that the rupee would have been much stronger than where it is right now. So it's about 73 odd right now. It would have probably been, you know, less than 70 given the sheer amount of money which has come in. So instead, they're just holding that dollars in reserves outside and bulking up their dollar holdings. So which to me is just suggesting at some point or the other, a weaponization of the dollar will happen. If I were to, you know, if hypothetically the US were to go to war with China, now you can go into the reasons of why that may happen later, but if you were to hypothetically go to war, the best thing to do, even before you actually fire a missile and do all those things, is shut them out of the dollar system. Because that will just cripple them anyway. They're very highly leveraged within China itself, and they are dependent on interactions with the rest of the world for their income generation to happen. So if you shut them out of the system, they have a big problem on their hands. They know it. It's not that they don't know it. Now, to what extent they have alternative plans in place, or they're just trying to hope something happens before, you know, they get there, we'll see how that shapes up. Now, what does weaponizing of the dollar really means? That you may shut them out of the system, or even before you shut them out of the system, you can start strengthening the dollar and suck out the liquidity from the world, which means people who are highly leveraged, once you start sucking out liquidity, get into a problem. The Chinese banks are some of the most leveraged in the world right now. Amongst emerging markets, by far the biggest dollar leverage is in Chinese companies. So if you start strengthening the dollar, they will have a problem. Which can have implications within China also if leverage, you know, that liquidity gets sucked out outside China. So, and if you wanted to strengthen the dollar, what you really want ideally is to have a weak dollar first, because when you weaken the dollar, the story builds up that, oh, you know, the dollar is going to end and all those things are going to happen, which means every speculator in the world will short the dollar. So when you're massively short, and then somebody who can change the rules of the game, which is the Fed or somebody or the government in the US or whatever, just comes in and gives some statement which changes that whole situation, where there could be something like saying, oh, we're going to strengthen, we feel a stronger dollar is required, or we think that, you know, the amount of money we've printed is too much, we need to cut that back. So any of those variations of those statements, and you could have all the speculators who have shorted the dollars really getting worried and covering their positions. And when you start covering shorts, it will just ramp up the value of the dollar tremendously. So, you know, all these things will happen. Now, first part, sorry, just repeat the first question. I forgot.
So just the question was, what is the implication for INR? Where is the INR going to move?
INR CBDC, you were asking, right?
Yeah.
So my sense is that, well, they may have plans. They haven't at least talked about it. And I would imagine Libra is going to be the thing. Because Libra was always planning on India as the, you know, the test market for two reasons. One, significant unbanked population. And secondly, at the same time, you know, obviously getting access to mobile phones and all that. And secondly, the biggest remittance market in the world. So cross-border as well as within country payment systems can happen using that. Now that Libra has entered into the deal with Reliance, all the more reason that that's what happens. If you see, you want to build an basically you want to build a payment system, you need multiple layers in it. That's what China is already doing. You've got Alibaba and all that with the commerce system. You've got Alipay with the, payment thing. You've got WeChat also with the payment and the customer base and all of that. So then in a payment kind of ecosystem, you need, obviously you need the currency, then you need that trust layer in between, somebody who can basically act as an arbitrator in between. And with digital currencies, it's very easy to be an arbitrator, right? If there is some issue happening, you can easily settle it if everything is happening in your ecosystem. And then you need the commerce layer within it, because without the commerce layer, adoption of the currency will not happen. And then you can create an entire multiplayer game basically effectively out of it when you have all these things set up in that ecosystem. So between what Facebook has and Jio's customers, you've got the customer ecosystem, you've got the commerce layer they're building, they can implement the trust layer and then bring in the currency. Obviously, they'll need the blessings of the central bank. RBI is issuing a license called New Umbrella Entity License, NUE, which is supposed to be like an alternative to something called the NPCI, which is the system on which the UPI and all that runs today. The requirements for getting an NUE, that New Umbrella Entity License, is exactly the same as the requirements for qualifying to become a commercial bank. The mandate is very open-ended, so you can interpret it whichever way you kind of want to. NPCI, which runs UPI and all, is owned by a consortium of banks. NPCI by itself is not for profit, but this NUE which will be created can be for profit. So to me, it just seems like that's just an excuse for creating basically your currency ecosystem. So within India, they may all use the rupee only with like a digital rupee kind of thing. Maybe the end account is with the central bank. And that's how Libra is morphing into today also, where there may be a cross-border element, which is like a stable currency. And then there may be an in-country element, which is linked to the currency of that country. So I think that's where we're going, I think.
Okay. Question, China has a lot of US government bonds. What will happen if China starts selling them all?
Well, if it sells it off, of course, the value of those government bonds will come down. Maybe they're doing some part of it right now. It's possible because, you have, let's say, if the dollar is going down and money which is coming to the US, you could theoretically take some part of that out. If the question is more to do with response to a war with the US and they start selling it and all that, the thing just is if the dollar appreciates and the bonds will do well. So that's the only part of their portfolio which will actually do well. So their incentive to sell that may not be so high. Now, whether they're blocked from, doing something or the other on it, that may be another case altogether. So that we'll have to see. At the same time, that kind of a situation could be one where they create an incentive for others to come and buy it. So then the selling impact can get potentially mitigated. So we'll have to see. I don't think it's as big a weapon as what it's made out to be. It can have some impact, but not as much.
Yeah, next question. The last time the US printed money in the financial crisis, the US stocks did very well in the next decade. So right now with the US printing a lot of money, will the same thing happen to US equities? Will they keep going up the next 10 years?
So I have a little controversial view on this. I think in whatever the next 1, 2, 3 months, whenever that high comes, will probably be a multi-decade high for the US. You probably will not see those prices for the next 20 years or 30 years or whatever.
Well, guys, can I ask a question?
Yes.
Okay. Sorry, Shiv, before you go, I think the previous one, are you saying, Debashish, that the stock market will crash in the next few months? From there onwards, they'll go up?
He says they'll not go up for many decades.
Yeah. So,
go ahead, Debashish.
Yeah. So when they come off from what I'm describing, it's going to take a while for it to, in general, go up around the world. Now let's break that answer into two parts. One specifically to US stocks, if you ask me, and then second is stocks in general. So stocks in general, some will recover, of course. That'll of course happen. But the kind of stocks which will work will probably be a different set of stocks than what has worked in the last decade and a half. The kind of stocks which will work may well be more commodity owners. And then, these cyclicals, because, you'll sort of have to focus a lot of energy and money into creating employment, which will mean you'll have to, create, and see, governments are not the most creative people in the world. So it's not like they're going to suddenly invent the future and create employment for you. They have to do certain things because they also, as importantly, apart from doing certain things, they have to be seen to be doing certain things. So what is the most common things they'll do? They'll build infrastructure. That's like a no-brainer. Whether it actually helps some country or not may be very dependent on the state of the infrastructure. Now, like for like, if we just take it like for like, of course, in India, if you build infrastructure, things will be better because it's so shitty to start with. But if you look at a developed market like US or whatever, European countries and all that, the infrastructure is already pretty good. So just by building more infrastructure, you may create some temporary jobs, but is it necessarily productive in the long run? Not so much. For those kind of countries, it's a lot more about, inventing the future, and inventing the future takes time, before that happens. Now, if you talk about a lot of the stuff which has got built and all that, I think a lot of the things which are valued today in the stock markets, and this is where it comes into the US side as well, are essentially consumer facing tech. Now, the next shift may be a lot more towards business to business tech, in which if you go into Gutti's presentation and all that about, IoT and all the work which is going on at the end of it, if the previous decade was a lot about connecting humans and, leveraging it into whatever, monetization models, the next part is going to be a lot more about connecting machines and leveraging that into monetization models out of it. And then maybe at some point you intermingle humans and machines and, create the singularity down the road. So that we'll see when that happens. But the next shift could be yeah.
What will happen to real
you
estate?
mentioned, real estate was my question as well. Is it a good hedge?
So real estate again depends where. Now, which country are you in right now?
Let's say US.
US. Yeah, US.
Okay. So US, again, you've got to see what real estate you're talking about. Now, keep a few things in mind. Firstly, in the US right now, let's say your mortgage rate is about what, 2.5%, 3% or something?
Yep.
And if you rent a property out, assuming you're able to find a renter, now that's becoming slightly challenging. But assuming in one of the big cities, New York, San Francisco, whatever, you were getting rents earlier, you were getting about a 4% yield on the property. So you bought the property, you gave it out on rent, you probably made about 4%. So you were borrowing at 2.5%, 3%, renting it at 4%. It was a no-brainer. It's like, the rent is more than paying the EMI. Now, if we, however, have the situation where the tax rates are going up, or they will go up, because of all this money printing, all this required, and people start exiting, especially the wealthiest start exiting out of New York and out of San Francisco, which is already happening, and move to whether it's in Austin or they move to, wherever, Middle America somewhere, or Nashville or wherever it might be. So real estate in Austin and Nashville and all that may do well. Real estate in New York or the tri-state area or the Bay Area and all that may face a severe fall. So that's just on the population movement part because of policy action. The second part is interest rates. Now, if down the road we start seeing, interest rates start to move up, then the mortgage rate doesn't stay at 2-3%. That can become significantly higher. And if the mortgage rate becomes significantly higher, then, either you can choose to pay a much higher rate of this thing, or if simultaneously, the renters are effectively moving out because those cities are depopulating. So the rental yields won't really move up as strongly. I mean, that's really what you have in India, for instance, right? I mean, your rental yields are like 2% and your mortgage rates are at 8%. And the real estate has basically gone nowhere in 8-9 years. So you could have that situation, or it could even fall in certain places. So given how bid up real estate already is in the hot markets in the US, I'd be worried about that.
Hey, boss, this is Shiv.
Thanks.
This is Shiv. I have two questions. Can you hear me clearly?
Yeah.
So first question is, with the outlook published in this slide, let's say I'm taking example of a passive average Joe investor who has some company stocks and he is, himself invested somewhere. So how long will it take for him, even if all this downturn happens, how long will it take for him to, recover all this, his investment and wealth? That's
Okay,
first question.
so what you asked was if you have a passive investment, is that what you asked?
Yes.
So if this downturn happens, and how long will you recover and so on, right?
Yes.
Okay. So firstly, I never look at an investment as a passive investment, firstly. So passive investment, let's say what we're defining it, let's say I'm buying an ETF or something like that. Is that what you meant by passive?
Correct.
So the passive investment is only passive from the point of view that the manager of those investments is not doing anything. In the sense he's just tracking the index. Okay, the index itself can of course go up and down, right? So as the manager of the allocation of that ETF, you may have to be cognizant of what the situation will be. Now, if I were to anticipate that the markets are likely to go down, then it doesn't make a whole lot of sense for me to be buying that. I may instead buy an inverse ETF, for instance, which can participate in the markets going down. So that's one way to look at it. So you actually have to be an active allocator of passive money. Now, passive money works best when broadly your real rates are negative, your volatility is quite low. So things are smooth and things can go up in one straight line, okay, which is what you've seen over the last decade. However, none of that may be true over the next decade because of a bunch of reasons. Firstly, you could have these periods where things are looking bad, and then there are periods where there's money printing happening. Net, if you just look at this year, right? I mean, if you just went to sleep in January beginning and got up today, your market is almost exactly at the same place. So your passive investment by itself may not have made money or lost money, it's still there. But if you were awake through the year, you would have seen massive swings, which just happened, right? So, but that is again, when the market has come back to where it is. But tomorrow, if the market goes down, then, obviously you don't make that money. So you have to be taking a little more of an active decision in terms of your allocation of what you're doing. Secondly, when interest rates are so low, then the yield can change very quickly. And a small change in yield can have a big impact on that whole thing I was describing, that bond yield versus price earnings and all that. And let me give a practical example of that. Let's say today if the yield is 1%. If I invert that into PE, it becomes like something like 100. So up to 100 PE, everything is fine. If bond yield goes from 1% to 2%, then the theoretical value of my PE, which was 100, now comes down to 50, which means my thing has just halved. Now 50 may still be an expensive PE, and that's a different matter, but 100 to 50, it's a big shift just because of 1% change in interest. So the impact is outsized when you have low rates of interest. So that's why when you have this kind of shifts, the money flow can be very rapid in different directions. So which creates big gyrations in the market. So volatility is very high. When volatility is very high, it's kind of harder to actually just sit on something and make money. You have to do some amount of timing when to get in and when to get out. So that's my point on that, really.
Okay.
And then if you have down the road interest rates going up, then the theoretical PE you can have comes down. So if interest rates go up from 1% to 5%, your theoretical PE comes down from 100 PE to 20 PE. That's a massive shift which can happen.
Right. Okay. One more question, boss. I think you partly already answered it. So in the next decade, I mean, whenever market goes down, there are certain sectors which always do better. So in this case of the next 5-7 years, what you said, commodity and agriculture, or can you?
Yeah, so I'm broadly looking at, agri, I'll look at, I think in general, industrial companies, manufacturing companies might do better. Commodity owners will definitely do better because their products will be in demand. Gold companies will probably do very well. Agri, crop growers will probably do well. So it's just that it's a completely different set of companies than what has worked in the last 10, 12 years. Now, of course, we have to see as we go along how technology also evolves. Now, but broadly, if the previous decade was a lot about the creators of the technology themselves, I think the next decade is going to be a lot more about how you productively use technology, whether in manufacturing, whether in agriculture, whether in different things, and kind of, build your ecosystems out of it. But it'll probably have a lot more interface between the digital and the physical world, which is really what the crux of it is. So your IoT, if you look at it, at the crux of it is really the physical world, digital world connect, and sort of bringing it all together. Whereas the previous consumer tech has been a lot more digital. Yeah, sorry, go ahead.
So basically all this internet networking infrastructure and the telehealth and all this, you think they will have a big
Well, I mean, probably it will. I don't know so much about telehealth specifically. I think in any business, I think one really has to see what is, the business itself may be viable. But what is the kind of competition which comes in, how easy it is to do something, which means how many other people can also get into that business. Now, telehealth, again, I don't really know much about it, and I haven't really evaluated any companies which do telehealth. But on the face of it, it seems the barriers to entry may not be so high. That's one. And secondly, you may still have to have that entire ecosystem in place for people to have faith in, some of those things to happen. Which will mean, again, who's able to build that ecosystem and, do that. And by ecosystem, it means everything, like whatever you need for telehealth, whether it's the hospital thing, the testing thing, the, devices connected in, all of that. Obviously, a bunch of money has been going into healthcare tech. So that may play a part in all this. How much of procedures can you do by, sitting remotely and all that, open to question. There's a certain psychological element also involved, much like how financial advice works. In health advice also, there is a psychological element involved in this whole thing. So how much can just be, implemented via that or not? But again, I'll say I haven't never looked at companies there, so I may only be able to say at a limited level on this.
So Debashish, this is Ashish here. And just one quick question. Yeah. So whatever you how much of it is your experience and how much of it is like theoretical gyan? Like if you can give any particular books or things you recommend for us to read going forward.
You mean how much of my presentation is my experience and how much of it is theoretical gyan?
Yeah.
So look, I mean, everything is a combination, right? I don't think you're going to find everything in one book. So what you're seeing is probably a distillation of whatever I might have learned over like 15, 20 years.
Okay.
I've kind of tried to put it together into something. There are, of course, multiple books which are out there. I think some of the best books I've read, again, depends on what you want to do. But if you're looking at trading and just understanding markets, I think Reminiscence of a Stock Operator is one of the best books which have ever been written. It was written in almost 100 years back. It's a fantastic book on that space. If you're looking at more towards, the tech side or in, how things will shape up, companies, what to look for and all, I think read something called Running Money by Andy Kessler. Extremely good. A fairly simple one book which almost anybody can use it just to evaluate stocks is called Beating the Street by Peter Lynch. You can look at that. I mean, there are many books out there. I mean, I think it's a lot of it is just about there's this book called The Most Important Thing by Howard Marks, which also, talks about a lot of, elements to look at in markets, and to what extent really, psychology, behavior, all these things play a part in all of this. So some of the psychology, behavior parts, which, and the interlinkages and all that, those are things which I think you just kind of build up from experience, only just seeing it and, living through it in some ways. And then, probably try to put it together.
And coming to your personal portfolio, any particular framework you follow for your personal portfolio in terms of international exposure or around various asset class?
No, I mean, I don't think I specifically follow like that I should have so much international exposure or not. I just take it more simply in terms of what my views are on different things. So for instance, right now, like, let's say if I have a positive view on gold, for instance. So there are different ways in which I can play gold, right? I would have some physical gold, of course, because if we really get to Mad Max world, then you need that physical gold. Then I would have some investments maybe through gold ETFs. In India, you also have these sovereign gold bonds, which are a great instrument because they give you 2.5% return. They give you the upside on gold. And if you hold it for the entire tenure, you'll get tax-free returns. So that's awesome. And then there's a part which I cannot get in India, which is gold mining companies. The way gold mining companies work is that they have a certain cost of production, which if you follow gold prices in dollar terms, so it's about 1900 odd right now. Their cost of production is about $1,200 per ounce. So a year back, gold was at $1,200, $1,300 per ounce. Today it is at whatever it is, 1900. So their profits have expanded dramatically. So obviously, they've become more valuable because of it. So gold mining companies are not in India. They're available abroad. So I bought some abroad. So it just depends on that, like what is available where. I used to be in the US earlier, so I had an account there. So some of the tech stocks initially I'd picked up over there. But then, once I'd moved back to India, and then they started, bringing in these new laws of having accounts abroad and all of that. So then I shut all that. And then I just bought, there's an ETF on the NASDAQ, which was available. So I had bought that. Both Ken and me had bought that like some years back. So we just bought it and kept it and all that. So it would be more like, dependent on what particular view I may have and therefore decide to buy something. It's not, I don't necessarily follow that it should be target this much, target that much. I think that's a waste of time. Right now, I think the bigger thing I'm just waiting for is a bigger play on the dollar itself. And the way I'm playing that is through the currency markets. So you have currency futures, which are available in India also, and not so great as the currency markets, which are there abroad, but it's fine. It's functional for what I want. So I'm basically betting on, I will be betting on dollar versus euro, dollar versus yen, maybe dollar versus pound also. And then, may have that as a certain percentage of the portfolio for that phase. So it'll just depend on, the view at that point in time.
So thanks a lot, Deba. I think we're out of time for further questions. Please send additional questions to the KREC Oriented group, and Debashish will hopefully answer them as soon as he can when he has time. So I'm going to close off recording now.